Yes, sir.
Okay, thank you so much. Good morning, and
Good morning.
I hope you all had a chance of going through what we discussed last time. And we had been going through this deposit insurance and the reasons for deposit insurance, why it was introduced in Sri Lanka, and then continuous failure of finance companies, banks, of course, licensed banks, of course, we did not have that many issues, but then finance companies were failing, and then there has to be a safety net for the customers. So which started in 2010 with a 200,000 guaranteed amount for a customer, which has been increased to 600,000 in by way of the amendment issued on 5th of Jan 2018. So what it means is that anybody who is having a deposit will get a minimum of 600,000 guaranteed amount if something happens to the financial institution. So for this purpose, we were looking at the kind of premium the banks will have to pay because central bank, they will have a reinsurance arrangement with reinsurer, and then premium had to be paid to the central bank. So for this purpose, the banks will have to submit the details of the customers and the deposit details, name and ID card number, and the details has to be given for a particular period, and then for that insurance premium had to be paid, and thereafter on incremental basis, who has been added, increased on them, the insurance premium had to be on an incremental basis had to be paid. This is one-off premium basically guaranteeing this amount. So you will find that time to time for the adjustment insurance premium is being paid. So this is about deposit insurance premium, a safety net for the customers. In countries like ours, this is felt necessary due to the reason there are so much of unsuspecting customers who get caught to failing finance companies. So we had many finance companies which were failing in the recent past. The last we had the Swarnamal Group 1, 2. So the finance Swarna Mahal in all in the recent past we saw. So these for these companies, for the customers, government keeps that in mind that we should have a safety net, right? Then we went on to look at the Basel II capital adequacy framework. We talked about operational risk. On the operational risk, of course, we were looking at what do you understand by the operational risk? So what are the events which will be considered as an operational risk? Because in Basel II framework, we looked at number one, credit risk, how the credit risk is measured, and then how the capital allocation is being done, we looked at, and then we went into operational risk. The operational risk, what are the approaches which are available right at the moment, we looked at. And then for different approaches, starting from the standardized basic indicator approach to advanced measurement approach, how the calculations differ, we looked at. Basically, banks do go for basic indicator approach until they are very comfortable with their data, right? Then, of course, we looked in to the other methods also, how they are being calculated, and how the risk-weighted amount is calculated for operational risk we looked at. And the standardized approach, and then the other, in the standardized approach, the second approach, of course, we found that instead of the gross income is being divided into 8 areas. Under 8 areas, there is a beta value given by the by the central bank, by the Basel Committee. And then based on that, you divide this gross income into various areas, and then in that you apply the particular rate, and then try to arrive at this particular capital requirement. And then we then looked at the next one, alternative standardized approach, or the advanced measurement approach. In that, of course, for two areas we looked at, instead of the gross income, we apply a particular for that portfolio, lending portfolio, whether corporate or whether retail, or like, I mean, on that we apply a M factor, 0.035 M factor you apply, and get others remain same. That is the last two of the indicators. There we found that total outstanding loans and advances in the retail banking business, and then total outstanding loans and advances in the commercial banking business line. Basically, those are like commercial loans what we give, corporate and retail sector also, like commercial loans. Others are the loans which come into retail banking sector, right? So that how we looked at the particular calculation. And for the last two, the other previous one, of course, we found that, I mean, all we have a beta factor, and all we can multiply by the particular gross income. But then here we are multiplying the gross income with a beta factor, not the gross income, but the particular turnover in that particular area, retail banking and commercial banking. That's the calculation which is given here. We look at the total outstanding loans and advances under that particular portfolio, and then you multiply by a M factor. So when you total it up, you get to the weighted average for the calculation of capital requirement under for the operational risk, right? Then we went into a bit of corporate governance, and corporate governance area basically is a little bit of a big area. Even though I have put the salient features in a few slides, it's a bit of a big area. So we are not really going deep into the corporate governance, but then what you should understand is the board, what are the things to be done, how the board of directors are appointed, how the executives in the corporate management are appointed in a bank, and what are the complying requirements, what are the restrictions, like those are all spelled out in the corporate governance. So few things we looked at are that, we looked at last time while discussing that a director cannot serve if he is above 70 years. Only after 70 years a director can serve. The maximum period a director can serve is only 9 years. More than 9 years, director cannot serve. And the director board will appoint a chairman out of them. And the director board only will appoint the chief executive officer also. So chief executive officer can be as per the bank's discretion, board's discretion, he can be executive director also. Executive director, by the term executive director, what we mean is that somebody who is an employee of an organization also serves in the board. That's what we call executive director. So you would have come across this executive director term various times. The basic meaning is that somebody who is an employee of the company. That means he is in full employment of the company and also serves in the board. So the laws and regulations related to executive director and non-executive directors are slightly different. So there can be what the corporate governance says is that not exceeding, I mean, the executive directors should not exceed 1/3 of the board. So if the board has, let us say, 9 directors, including the chairman, then the executive directors cannot exceed 3. That's the requirement. So the directors needs to be, I mean, they will be selected from various spheres of the business. In the sense, I mean, they may be academicians, they may be corporate directors, they may be finance, in the finance field. They are some veterans in the finance field, in the business field. Like, I mean, they will have expertise in wide areas, so that, I mean, they are contribution to the company sitting in the board will be kind of it will be a mixed expertise will be there in the board. That's the expectation. It's not that, I mean, everybody should be a banker, everybody should be a retired banker. No, it's not that. There will be people seated from somebody from a field which is not at all related to banking. They may be engineers, they may be lawyers. They would have been, past, legal luminaries who had served the legal profession. And then they can sit in the board. So they will be selected. I mean, lawyers will be selected, maybe academicians will be there, like, I mean, university professors can be there, there can be, marketing field experts will be there, business field experts. So the board has to be a mix of all that. So that only will be able to give a direction to a effective direction to a bank or a business. Right. Then we talked about the board, the management is a agent of the board. Basically, agency function is carried out by the management. So they, as an agent of the board, the management has to, I mean, they have certain do's and don'ts, what they should do, what they should not do. So those are prescribed by the board. Board prescribes what the management should do, what the chief executive should do, what the key management personnel in the organization should do. So the board has an oversight on that. So many of the things we looked at, which are like, I mean, the structure of the management affairs of the bank, delegating business operation to key management personnel, how that happens. Basically, delegation of the business operation to key management personnel done by the chief executive officer as appointed by the board. So we also looked at what do you mean by the key management personnel. Key management personnel are the people, like, who are the key people, who are the key executives, I mean, who take the decisions. Now, like what you say, in your bank, you will have kind of people in your business line. On top of retail banking, you will have DGM retail banking, or like, I mean, senior vice president or VP, something like that, according to the cadre which is appointed by the management, by the board. So, like, the people who are on top of these particular business lines, they will be key management personnel, like assistant general managers, deputy general managers, right, chief operating officers. They and all will be key management people, right. The other thing what we discussed was that the board should also give a clear direction to the key management people regarding what should be approved by the board and what should be done at the management personnel level. So in that sense, you would know that, I mean, in the bank, in many of your banks and financial institutions, you will know that, for example, let us say risk management function. You probably will have a committee board subcommittee, which has a oversight on that. Board subcommittee like board integrated risk management, committee. So the integrated risk management, what is integrated risk is that the risks, important risks like credit risk, operational risk, and market risk. Now, credit risk, operational risk, market risk, and all that, I mean, these functions put together called integrated risk. Yeah, go ahead. Anyone wanted to speak? Right. The integrated risk management function, let us say you have a chief risk officer or somebody at the key management person level. There is a CRO, like, I mean, somebody at the level of AGM or DGM, you have looking after the risk area. So they will have many a times they will have a committee at the level of the management, something like executive risk management. Like at the management level, at the corporate management level, you will have executive integrated risk management committee, and then you will have another committee which is at the board level, board subcommittee, which is board integrated risk management committee. Now, all the risk related affairs, in that, what are the things which should be escalated? What are the things which should be taken up at the management, corporate management level? What are the things which should be taken up at the board level? These are decided by the board, and that is spelled out in the risk policy. So there will be risk policy. Risk policy will be in the approved by the board. In that, it will be spelled out clearly what they should do. Right. So chief risk officer. Now, for example, let us say take your credit policy. We look at the credit policy of the institution subsequently also. Now, a credit policy spells out, what is your credit appetite, what are the sectors you will be lending, what are the sectors you should not be lending, how is the credit approval process, who and who will approve, what is the structure, what is the who will have the delegated authority, who will sign, and then exceptions, how you handle. All these things has to be spelled out in the credit policy. In the credit policy, it will say that, I mean, who will approve what, to what level it has to go, exceptions, how you handle, write off, how you handle, right? Write down, how you handle. All these things are basically spelled out in a credit policy. So credit policy approved by the board, and then there will be a executive level as a credit policy committee will be there, and then at the board level also board credit committee will be there. Board credit committee will take up these issues as well as approving the facility papers, the proposals, the loan proposals, which are coming under the purview of board credit committee. So this is the corporate governance part of those areas. So that's how the board and the management will function. So we reiterated that there should be a clear division of the responsibilities of the board, and then clear responsibilities on the division of responsibility when you come to the executive management. That's the corporate management, right? So that the balance of power. Otherwise, there can be conflicts, means it will be a problem. It will be a problem of management, corporate management, anything trying to challenge the board or board challenging the corporate management. It's not a good thing for an organization. So these are important things. Like, we looked at board appointing committees. Depending on the requirements, board will appoint committees. Say, for example, board will have a nomination committee of non-executive directors forming a nomination committee. This nomination committee will sit and discuss on who are the people who has to come to the become a KMPs, key management personnel, who will be the CEO, who can become chief operating officer, who can become other management people, who can become head of corporate banking in the sense, at the level of a DGM, AGM level, who can become in the corporate bank, who can in the retail bank, in the consumer bank, who can become a say corporate management level executive for legal affairs. So like that, how many people should be there at that level? So all that will be decided by the board, and the board will have a appointed committee, of board nomination committee, which will go into individual people. They will go into that and then select them. I mean, basically, the corporate management will have to recommend. So and so we recommend that to be appointed at this management level, key management position. But the board will do the part of interviewing, going through the suitability and identifying a suitable person. All that part is done by the board nomination committee. So last time we looked at, I mean, if let us say a CEO or KMP is selected by the board nomination committee. From that point, there has to be a affidavit filed with the central bank also. The affidavit will spell out the track record of the particular executive, like what was he, where did he work, what are the areas he has covered during the last 5 years' time, any issues, what are his qualifications, what is the suitability of being appointed to the proposed position. Is there any other disciplinary related issues he has? What are the accounts he is maintaining? How much of balances in his accounts? Right? What are the loans he has obtained? Right? Whether those are current? What are the other assets he has? Right? Other investments are what in the financial assets? What are the things? What are where and where he has invested in the same institutions? Shares also, whether he has invested, how much he has, who are his dependents, whether who are the spouse and children, whether any of the connected people of this proposed person is a close relative, is working in the same institution or any other financial institution. All these details, and there things has to be given in a affidavit that the central bank will have to approve. If the central bank has any concern, they can say that he is not suitable to be appointed. Right? That part, every financial institution will write and get the central bank's approval. You would have seen that in the share market declarations and all. Normally, when someone is appointed, they will say central bank's approval duly obtained. So that is this. You will have to file a affidavit of the person, and then central bank will give the approval. So central bank also is very careful about these related party transactions. Now, related parties may be, doing transfers between the subsidiaries. Let us say your bank is a group of companies. There's a bank, there is a finance company, there is another company which is handling real estate. Let us say, in that case, in between the transactions of the subsidiaries, let us say the bank is lending to the particular finance company or the particular real estate company, or they are lending. That has to be ensured that is done without giving any preferential treatment. You do it as if you are doing with other customers. So if any transaction like that happens, it has to be declared as a related party transaction, and it has to be ensured that no favorable treatment is given. For example, central bank had issues with Selinco group of companies, where Ceylon Bank lending to subsidiaries in the Selinco group, they had issues. The companies, how the loans are given, on what terms it is given, and then whether any preferential treatment given, and all that. On that, they had issues. So that's about related party. So then now lending to some other people, or lending within, or lending to even people who are directors in the companies which are related, which are connected to the directors. A director who is serving in the board of the particular financial institution may be working in some other company, right? For example, let us say director working in a commercial bank, let us say he's serving in the board of John Keel's Holdings. So if he's working in John Keel's Holdings, if he's serving in the board of John Keel's Holdings, there is a chance that John Keel's Holdings may be enjoying preferential treatment in the loans given by commercial bank to John Keel's, right? So those kind of things has to be declared, and then say that, it has to be declared to say that, these are the loans which are enjoyed by this company, and there is a director who is serving in both the boards, and no preferential treatment given. So that kind of a direction has to be. So about the related party transaction should be given. So we were looking at corporate governance requirement, of course, there should be 7 board members minimum, and then 13 should not exceed 13 board members, including the chairman. Then we also saw that the chief executive officer, a director cannot serve more than 9 years. But then the executive directors will be exempted from that, because executive directors, as I told you, executive directors are the working people. They are employees of the company, right? So they will not have this 9-year rule. But non-executive directors have the 9-year rule. So this also we looked at, right? So the requirement is that there should be NEDs, that is non-executive directors who are independent. Now, we looked at who are dependent people, who are independent people. For example, let us say in your company, let us say IFC comes and takes 10% of your shareholding. So they come in, buy the shareholding 10%, or some Mark PSO, some fund manager who is buying 10% of your shares. Or let us say in Sri Lanka, Mr. Dhammika Perera comes and takes 10% of your shares. So with the 10% of the shares, he can put the pressure on the management that I won't appoint a director. So the director can be appointed, and then with the board's approval, a director can be appointed who represents the shareholding of such investor, whether IFC or whether it is Dhammika Perera, or such investor, a director can represent them, in the sense 10% shareholding represented in the board with a director. So such directors who are representing a shareholder is not independent. They are not called independent. The independent directors are the people who are kind of appointed to the board by the merit of their suitability, who are representing the larger public, who are not a representative of a specific shareholder, but the larger public. So they are independent. So there is a requirement that 1/3 of the total director board should be of independent directors. So they will have neutral view. They will not be influenced by a particular shareholder to take decisions to favor the shareholder, that particular shareholder, right? For example, let us say a big investor in Sri Lanka has invested in your bank for 10%. So that particular director appointed by a particular investor, shareholder, he will try to support the resolutions which are in support of the particular business, right? So it can be biased. It can be biased. So that's why a corporate governance code says that you should have at least 1/3 of independent non-executive directors, so that they will act in the interest of the large public. So there is no bar for a particular person to serve, twice in a board. I did not see any. Last time we discussed also in a board, but then it has not happened as far as I can see. Normally, when somebody serves in a board and then he completes his terms and goes, and again he being taken back to the board is something which I did not see in the bank boards in the recent past. And probably the corporate governance code of central bank also doesn't really say that, it cannot be. He doesn't say it cannot be. But they say that, currently, though during the period of 2 years immediately preceding his appointment as a director, like he shouldn't have done any business transactions with the bank, right? Exceeding 10% of the regulatory capital of the bank. So a director will not be appointed to the board if he has any close relation. Close relation, like, they have these spouse and siblings and that kind of a relationship. If he has with a chief executive officer also, that kind of people will not be appointed to the board because they will be acting with a vested interest. Okay, other areas we looked at, employee director, material shareholder, if he is representing a particular investor, like, they will not be independent, they are not independent directors. So these prescriptions are who are the independent directors, right? They can be appointed, but then they are not independent, they are dependent. Right, these areas I think we have looked at. So on the corporate governance, that's what we were looking at last time. I repeated for the simple reason, giving you the important areas for the simple reason. This is, as people who are doing postgraduate course in bank management, you should know what is about the management, what is about the board's functions precisely, and what are the do's and don'ts, how do they function. These areas, you better have a knowledge. Then only you will understand the sense, how these approval processes are taking place, how the credit big proposals are approved and all that. You need to understand. All right. Any questions, please? Any questions on this? Yes. Are you all sleeping? Are you all listening or sleeping? Yeah, you can type something. Let me see what you checked. Are you all okay with this? Did you all understand? Do you have any problem? Go ahead.
Yes, sir.
Yes. Jeepan, thanks. Right. Um, See, I am talking to a wall, right? I am talking to a wall. You should understand. It's not a classroom. I'm talking to a wall, so that I'm a little bit communicative. You being little bit communicative is better. Otherwise, I just, it's not an easy task, like, 3-4 hours continuing a class, just looking at a screen, which we are not very familiar with, right? So being a kind of a, person who enjoys a live classroom is really difficult. I mean, for that matter, anybody it will be like that. So I don't think, like, I mean, it will be such a pleasant task like that. So that, I mean, we being a little bit communicative would be better. It is good for you, good for me. Right? Okay. So we go into principles of credit management. Right? So all this time we had been talking, many things about how do we raise funds, what are the ways of raising funds, what are the different institutions in the market, banks and finance companies, non-banking financial institutions, venture capital companies, and various type of companies. How do they raise fund? What are the methods of raising funds? What are the pros and cons of raising funds? Whether it is good to get the deposits, whether it is good to get the interbank this one. What are the perils? What are the dangers of getting interbank, funds? All these areas we have looked at, and then we have ventured into the Basel II Accord. Basel I, we briefly looked at. Basel II, we looked at up to the credit risk, market risk, and operational risk. How do we calculate, and how do we arrive at the weighted average capital for the calculation of capital? Also, we looked at, and then briefly I may have to cover in the Basel II, Pillar 2 and Pillar 3. So basically, in the Basel II, Pillar 2 is talking about internal capital adequacy assessment process. It's called central bank. We'll have to submit a return. In that return, we will say how we have calculated our credit risk, our operational risk, our market risk, and how have we whether then we will talk about our rationale of doing that, and then we talk about the adequacy of the particular capital allocation, whether we have properly allocated weighted average capital adequacy calculation, whether we have properly done, whether we have allocated capital properly, and then our capital allocation, whether this process is acceptable. In that that is the assessment, internal assessment process. So you do the assessment process, and then there is a return to be submitted to central bank. The central bank goes gets it, and then goes through that, and then says whether your process is okay. They will tell whether your capital allocation process is okay, whether you have correctly identified and then allocated for your credit risk, correctly identified and allocated for your market risk, same way to operational risk, whether anything you have overlooked, you haven't taken into account, any vital misses are there. All that they will look at it, and then they will say whether they accept it or whether these things, subject to these things, you will have to do. So that kind of assessment central bank does. So that's what we call ICAP, internal capital adequacy assessment process. ICAP we call it. So that's about the Pillar 2 of the Basel Accord. Then the Basel 2 Pillar 3 talks about the market discipline. That is basically about about the company, all the information you should give to the shareholders and the general public. So that's market discipline. In market time, declaration of the vital things to the market. So that that disclosure part only, if you take your annual report and see to the market, what and what information is given. Like, I mean, it gives, like, I mean, about the company, their financial performance, and their I mean, directors, who are the directors, what are their qualifications, management KMPs, what are their qualifications, what are their experience, what they have done, what is their related party transactions. I mean, the entire gamut of, as much as possible, Basel III asks the organization to be as transparent as possible, give all the information possible to the shareholders and general public. So that's about market discipline. That basically covers the Basel II Accord. So Basel III, of course, we will briefly cover that, right? We will look at the Basel III subsequently. Anyone wanted to speak? Right? Okay. So today we are going into important credit area in the credit management, right? So I will be going from the from the preliminary level. I will go, because this is about the subject what you are studying. It's very important, right? Okay. So can somebody type and tell me who are the people who have not handled credit? How many have not handled credit? How many of you haven't handled credit? Just say that I did not handle credit. I do not know. If you have done credit, you just say I done credit. I have done credit, or I am doing credit. Right? Credit means your lending area. You are involved in the lending area, or you are involved in other areas. Like, I mean, customer service, account opening, FD opening, cash, and that area. That is operational. Yeah, Ajipan is credit department, right? Okay. Metmal Gamage, yeah. So I'm doing credit. I have done credit. Okay, Tilipan, Nilanta, done credit. Nilanta Priyadarshana, I have done credit. Ketaki, Mahagamage, haven't done. Then right. Okay. So I think a lot of people have done credit. Some have not done credit, right? I think majority of you have done credit. Some have, haven't done. Madhuma Valpola, Dick Manoj, not done. So okay, so that I will try to be, I will try to pitch it at the level where, I think that there are enough of people who have not done credit too. So I will try to be careful about that. Right. Now, like what we were discussing, the loan originating in a financial institution, right? It differs between amongst organizations. So it depends on the organization structure. Even though in principle, at a macro level, it is kind of same. At micro level, you will find, different ways of handling, right? Different structures are there. Different structures are there. Different delegations are there. The delegation, I should tell you, before starting itself, I should talk about delegation a little bit. Delegation of lending authority is a very sacred function of a financial institution. Delegation of lending authority is that if you are a manager of a branch, if you are a relationship manager in corporate banking, if you are a relationship manager in any of the leasing department, or like, I mean, wherever, and then you will have hierarchy. So let us say there is a relationship officer, relationship manager, there is a regional manager setup, regional manager, and there is a VPO, AVPO, like, I mean, assistant general manager setup, and then deputy general manager setup, and then on top of it, chief operating officer, then CEO, then above that executive credit committee, and then board credit committee, and then board of directors. Like that, there are different layers are there in an organization. So the delegation of lending authority is who can approve what, right? Who can approve what? So what happens is that if a manager is given the authority to approve up to, say, 1 million, you can approve up to secured facility up to 1 million, unsecured facility you can approve up to 200,000. If that is, if it says like that, secured facility means you have some security covered by mortgages, covered by mortgage, property mortgage. That is a secured facility, covered by other acceptable security, right? Unsecured is that you don't have security. So for namesake, we will have some guarantees, personal guarantees and all that. If we go for it, and then that's unsecured security. So now, if a manager has been given a DA, we call it DA, delegated authority, of 1 million and 200,000 unsecured, means he can go up to 1 million on secured basis. He can go up to 1 million for a customer. So let us say the facility is 1.5 million. The particular proposal, it's about a working capital facility for 1.5 million. Now this gentleman can approve only up to 1 million. Now this is 1.5 million. Now it has to go to the next level. Then he has to go and recommend it. So somebody who is above some proposal which is above somebody's delegated authority will have to recommend it. So the delegated authority, I have to tell you something very important, but you should understand, is that who can delegate the authority? Who can delegate the authority? Now, the power to delegate is solely lies with the board. The board delegates, right? The board only delegates. Then your chief executive officer or the managing director will be given a kind of a power of attorney for him to act on behalf of the board. So, because board cannot, at a lower level and everything they can see and manage, they have given the power of attorney to the managing director. So the managing director, what he will do, he will delegate. So the CEO, managing director, he will delegate. You would have seen that only MD will delegate. Others are not empowered to delegate, right? Say for example, a manager. Manager is having this 1,200,000 delegated authority, and he goes on leave, and somebody else is coming and looking after the job, right? A temporary assignment for somebody to look after the job. He can't go and approve these 1,200,000 facilities. He can't. He doesn't have the power. And manager, because he goes on leave, he can't say, I am delegating my power to the person who is going to look after. He can't delegate, right? So that's very important for you to understand. Delegation of lending powers are cannot be delegated by the people to whom it is delegated, except for the chief executive officer or managing director. So the managing director will always issue the letters. When somebody is appointed, he will issue the letters. So that to the name is not for the position. It's to the name they will give. So and so put the name, and to you, these are the delegated authority, and you can't delegate it downwards. So all that will be mentioned, and what are the facilities, how much of cash facilities, secured against cash, how much, unsecured, how much, leasing, how much. I mean, if they say that, I mean, in specific for personal loans means that that they may mention, or it will come under the big umbrella, and then secured how much. All that they will spell it out, and what kind of securities. Securities means what are the securities. If it is unsecured months, what are the things they will consider as unsecured. All that will be spelled out in a DA letter. That's called delegated authority, right? So
in our bank, it is only for the position they have.
You may have to increase your sound a bit. I hope. One second. Let me try to. Yeah, go ahead.
In our bank, it is for the position they have delegated.
Not for the position, it is for the position delegated.
Yes, sir.
So somebody who is on leave, if someone else coming and performing the duty, the power is given to him, is it?
That depends on whether the HR approves that with the delegation authority or not. But other than that,
okay. Now, yeah, it is. Okay, it is given to the position, right? Okay. Now, normally delegated, amounts are decided based on the position. So, for example, let us say manager so much, senior manager so much, chief manager so much, or regional manager so much. Like, I mean, for the positions, the amounts are decided, but the thing is issued in the personal names. DA letters are issued in the personal names. Sometimes, maybe having the control, like what you say. It would have been tweaked a bit in few organizations. That's what I say. These slightly there will be difference between the organizations. Now what happens is that like what you say, the particular person for the position they would have issued, but he cannot delegate. Like just because he goes on leave, he cannot say that, I mean, somebody who is going to look after my job, or the assistant manager is going to look after, or somebody else coming in place of me temporarily can have the DA to go and sign. That he can't delegate. So probably slight tweak is there, but I don't see the essence is diluted. Essence is not diluted. It is there. That still shows that only that person can perform using the delegated authority. So that is for the person. So unless if the HR with the approval of the CEO says that the other person can, but the ideal scenario under this delegated authority is that CEO gives that to the particular person, so that the other person doesn't come and exercise that, because that's very important also when it comes to let's say any legal issues also. If it's a legal issue, if the court asks for the lending officer, is the lending officer is the manager who has authorized, all the people who have recommended and authorized, all these guys become lending officers. I mean, they are legally also responsible. Now, it's not simply signing a proposal. There's a legal responsibility also is there. If there is any issue, bank will defend. That's okay. That's all right. But then the people are responsible. That I know. That I mean, Bank of Ceylon and all, they are very particular about that. Right. So I don't think the essence is diluted here. Right. Are you clear?
Yes, sir.
Right. Okay. Thanks.
Excuse me, sir. Whether the delegated authorities for the person or the person and branch, how it's determined?
Sorry, your line is not clear.
Okay, sir, I will type.
Hello, your line is a lot of noise coming from the line, and then I can't hear you. I think rest of the students must be feeling that also. I think the student who spoke just now, I can't hear anything, but a lot of noise coming. Can you now again try it?
Whether the delegated authority is only for the person or the person and the branch, how it's determined?
It's for the person. Delegated authority, not to the branch.
If the manager transferred to one branch to another branch, why the DA is removing?
Yeah, they will have to issue a letter. Now, it is to the person. Now, the person, now DA, now whenever a person takes over, in that appointment letter itself, it will be mentioned, like there will be a separate document which is going, where the DA will be mentioned. You will have a DA of this one, and then the rest of the areas also will mention. So, basically it is the person, but for the branch, they don't give. DA not given. Now, for example, let us say a branch is managed by a junior, let us say a manager level person. Let's say in the card, in the manager level person, he manages, and he has a DA. And then let us say senior manager comes there. He has a long experience, and then the CEO is comfortable in giving a higher DA to the particular gentleman. So that senior manager will have a higher DA for the same branch. So the DA is not for the branch, but for the person.
So, in our banks, these branches are given grades, and for the be a branch manager, this grade branch have a authority.
Okay, now it may be that they are mentioning for that particular. Now this also, like what I told you earlier, it's a little bit tweaked, and then okay, for you see, the organization structures of different financial institutions have different ways of doing. That's what I was telling from the beginning, is that here what has happened, in your case what you say is that the company, the financial institution, for the branches they fix these. Even though they fix for the branches, this is the amount for this particular branch, but the authority they will have to give to the person who is going, right? So now in your case, what you say is that, I mean, a person, irrespective of the fact that whichever card the particular manager belongs to,
That
he will
solves
get the
by
same.
assigning the person. This level of branch could be managed by this level of person.
Exactly. That way. So these are different ways of handling the same thing, but the essence of that, what you should understand is that delegation done to a person. Now here what happens is that, I mean, maybe the managers are selected from a particular card. In this card, people only this, let us say A grade, C, B grade, C grade, D grade. Okay, this C grade only this card people will go. For them, this is the power. Like, I mean, so they will give individual powers, but then the same amount is given for that particular branch. That may be, but in essence, the delegation is given to that particular person, not to the branch. In essence, but then for ease of operation to that branch, only that particular card of people are given, and the for the people who are taking up as manager in that particular unit, that amount is fixed and then personally delegated. That's how it will happen in your case.
Sir, our branch manager recently transferred from another branch. He's in manager grade, but
Okay.
now he said he don't have any DA, so we have to obtain approval from next authorities.
No, the authority has to come from the CEO only. He will give the CEO has to give the authority. But normally, under normal circumstances, CEO cannot give that power to others to, the corporate governance is that the CEO cannot give the power to others to give that you can approve this much. That is the normal, governance code. Now, do you mean to say, let us say, a regional manager will say that this much you can approve, something like that? Is that how?
Just previous manager approved some secured facilities and some facilities,
Okay.
but new manager also managing previous branch. He transferred to a branch, I think 2 weeks back.
Okay.
But he don't. He said us he don't have any delegated authorities. So
Yeah, they
he
will
has
have to
to
issue the letter, issue a delegated authority. It has to be given by the management. It has to be
So
given
I
by the.
think that based on the branch portfolio and the
Yeah.
experience qualification of the manager.
One is a branch
The
portfolio. More importantly, it is the particular person who goes as a manager. His experience also matters. Now, if you say even if it's a big branch, let us say juniors put there as a manager, then the management is not comfortable in giving him a DA. They will say everything you recommend and put it. So you go and canvas your business, no problem. You go talk to customers, canvas business, put proposals, recommend and put it. It's not going to stop the business. They can recommend it. In a way, sometimes even the manager will be comfortable in recommending and putting rather than approving and then later found fault with. Right, when he is not experienced. Right. So the looking at the experience profile, all that the management will decide whether to give or not, to what level to give. Clear? Are you okay? Any questions? Okay. So the DA we were talking about that, the essence what you should understand is that DA has to come from the CEO. He has to appoint people, delegate how much individual people should give. Now, like for example, in the process, the manager will have some DA or may not have. Next level, regional office, they will have DA or may not have. The regional office, regional manager and all definitely will have a higher DA. And the next level will be the AGM level or any other designation. And then there can be executive credit committee. There can be a DGM level. There can be, if there is chief operating officer, yes, or else a CEO. And then there can be executive credit committee, which comprises of 2-3 top executives. And then the board credit committee, that will comprise of the directors, and then finally to the board. So the proposal, depending on the amount, it will go through that. Let us say you have a board limit. You say anything above 1 billion should be referred to the board. That means if you propose a facility for 1.2 billion, this will have the signature of everybody down the line. Let's say the relationship manager, then the unit head, then the AGM, then the ECC, and then board credit committee, and then the board. And the way the board, it will be taken up and then approved and signed. So it will go through that. So that's how the approval takes place, right? Different levels of approval. Right? That's about the delegation which you should know. So different structures are there. Like what a few students just now spoke, structures may be different. Every bank will have a different structure. Now, like for example, 2-3 structures we can see. See, the proposals may be interacting with the customer, and then getting the proposal, and then when the lending officer in the branch is satisfied, after interviewing the customer, getting all necessary information, getting the profit and loss balance sheet, the cash flow, analyzing the cash flow, analyzing other risks related, right? Many risks which down the line we will see, whether financial risk or structural risk or what is the purpose, what is the equity contribution, all that you look at, and then you prepare the proposal. Now, One structure may be such proposal may be recommended by the manager and put up, and then it goes to the regional manager and then signed and put up. It goes to the AGM and then they sign it in DGM. Like, I mean, depending on the amount, it is signed in that category. That is one type of a structure. Another structure may be the branch will do only the part of talking to the customer, getting the information, what the all what we had been discussing about the customer request, all analyzed, and then all the information to be passed to a central location. Or in the alternative, just get the customer reference, all the the required documents, and then immediately just pass it across to a central location. Centralized credit processing. So that centralized credit processing, they will take and they will analyze all the risks and purpose, whether it is justified, everything they will analyze, and then if that facility can be recommended, what they will do, then they will do a proposal and then they will send it to the branch manager to sign off and then send it. So all the credit appraisal process, we call it appraisal, credit appraisal. This credit appraisal process is done at a central location, and which is given for the branch manager to sign off. So you will have different softwares in your bank for loan processing, loan origination systems. So in the system, maybe if it is a system-based thing or if it is a manual-based thing, you do that and send the proposal for the branch manager to sign and put it upwards. So those are two structures what we look at. So different organizations will have different structures of handling loan proposals. So it can be kind of a vertical type of a thing. It can be kind of a hierarchical. It can be type of centralized processing. Anything. Some banks have that branches to function only as a kind of a marketing unit. So branches will do deliver the services to the customers, like the cash flow, the kind of even account opening and all that. They will take and send it to the center. Get the customer information, send it to the center. Even account opening will be done at the center. So customer, if he asks for a loan, get the information, forward it to the center. Center will process everything, and then send it to the manager to sign off, or even from there itself they will take it forward. And then once the paper is approved, facility paper is approved, proposal, even processing about taking the documents from the customers, like signing a letter of general terms and conditions of loan and other security documents, all that. Also there are banks which are doing centralized process, banks which are doing branch-based process. In branch it is done with a centralized process. So like what I told you, different structures and different approval processes are practiced in many financial institutions. It differs, but the essence is kind of is same, but the structures are different. Okay. So that's about like what I told you. If a customer walks into a branch, or if a customer gives a call, the branch staff gets the details. So in a centralized thing, they give it. In a decentralized setup, they will get the details, and then they will start going to the next level of preparing the proposal. For preparing the proposal, number one, the credit officer or lending officer will satisfy that whether this kind of a loan can be given. First of all, whether it can be given, whether customers' request is justified. So you will look at all the risks There may be customer who is, for example, walking in telling that I have a house at Colombo 7. This house is now worth about 150 million. I want 10 million cash urgently. I want to go and put a deposit and show for a visa purpose, they can say. Now you will look at the purpose. When you look at the purpose, you will see, okay, security is superb. 15 times more security you have. He is asking 10 million, the house is worth 150 million. Security is fine. The purpose is making some deposit and taking some something like visa purposes. Then you ask, how are you going to repay? Repayment, of course, he says that okay, I am not doing any job. I only am trying to go abroad and find a job. And I probably, after my taking the visa, I will take the deposit and then take it out and then settle, and balance I will settle after going abroad. So as a credit officer, as a person, credit officer, you will look at it and then think that there's a problem with the purpose, right? There's a problem with the purpose. More than that, there's a problem with the repayment capacity. This gentleman is not working. He is not generating any cash flow. This particular deposit is not going to, I mean loan is not going to go into any productive purpose. He is asking for some to take visa something. So he talks about settling majority now, all that kind of. So you have a problem with the repayment capacity and the purpose. So even though somebody has given 150 million security, you may go to deny it. You say, sorry, we won't be able to do this. So you have problem with the purpose and repayment capacity. So those, those part you will do. Then only you will start preparing like what we discussed, the other, proposal and all that. So lending officer will decide whether this is okay. Somebody can walk in and say that I have a factory, I'm running the factory, so I have some cash flow related problem, and then you give a 50 million loan. So you look at, okay, other things are fairly okay, but you look at he has borrowed from 2-3 banks, and he is finding it difficult to service them. And then all this money has gone into the factory, and then it's kind of a lot of capital investment, but the turnover is not there. Then you will say that, you will think that, okay, now this many, more than 100 million years obtained from other banks. And after investing so much also, his cash flow is not sufficient to service those loans. He's trying to take another loan and, kind of, be on the surface, manage it. So you will find that, even though factory business turnover, all that is there, as a lending officer, you will find that no, this is not sustainable, right? So he will go and roll it out. I give a working capital facility, he will go and settle the other loans, and then other loan commitments he will try to settle, and then I will be in the same boat like the other banks. So you may even you may very politely deny it. No, I can't do this loan. I can't look at this. So it's about the lending officer. So from that only it goes to the level of then next level of preparing proposals and then recommending and all that. That's the next step. Number one, somebody who has to assess. So whether it is at the branch level somebody is assessing, whether it is at a center, it is by something is being assessed. The staff from the central location calls the customers, gets all the information, and then they come to a particular conclusion, then say that we may not be able to continue with this particular proposal, let's deny it. All that at different levels it has to happen. Right. Are you clear about this, what we discussed? Are you okay, what we discussed?
Yes, sir.
All right. Thanks. So we were talking about delegate authority. We were talking about how initially you will do the assessment. So it depends that, For a big company also it is the same. For somebody who is coming for 100,000 personal loan also it is the same. You will look at in the same way. Let us say a teacher comes to you and asks for a loan, and then you find the teacher is getting about 25,000 salary, but then he has already borrowed from other banks. Or he has borrowed from the particular school setup itself, and then he has repayment there. And then you will look at it and then say whether he can repay the loan, whether it's a possibility, whether he is over borrowing, right? You may deny. Like that, over trading. For a trading company, you will go and see that whether somebody is over trading, right? Somebody is talking more. You will go and see that, I mean, somebody is coming and asking for a working capital facility, and you go and see the particular person's site. You find lot of stocks are there, whole lot of stocks. For 2-3 years, he has stocked it. Then he says that I have 100 million worth of stocks. I know that these prices will go up, so I can sell this. So I want for working capital 20 million facility. You give. I have this much of stock. So you will go and see that, I mean, these stocks are there for 2-3 years. Some of the things would have become unsellable, and you may decide that I may not give, because this guy is talking about 100 million in stocks and keeping, and then which is not moving, is not a good business model, which again your working capital what you give also will go and get stuck there. So like that, whether it is personal loan, whether it is business loan, whether it's a big company can walk in and ask you, I am going to buy this particular company. They will say, there is a particular company which is now currently suffering. I can buy that company, go and rehabilitate that company, and then make profits. So give me 500 million facility. 500 million facility you give, I want to buy that company. So as a corporate banking relationship manager also, you will go and see that whether this is an acceptable proposal for the customer. Customer is right at the moment is a good customer. It's a good borrowing customer. But then he is asking about buying another company. That company talks about investing about 500 million. Then you look at that particular company, you find that that business is not your customer doesn't have any exposure to that line of business. He doesn't have exposure. He is relying on somebody else who is telling that, I mean, that business is good, you can do, all that. He doesn't have his own assessment. Somebody else is telling you can do that. And that particular company had been in business and then really down. Their product is not very attractive in the market. Their competitors are not doing very well. So let us say that, I mean, looking at all those things, you think that, I mean, it's a high risk. Then also you will think that, I mean, okay, I better not go, and now he is a good customer. By giving this 500 million to this customer, I'm going to put this customer into a trouble. He will go and invest, and then he'll get stuck, and then for that repayment, even from your good cash flow from the existing things will get stuck. So I better advise this customer not to go for it, and then reluctantly say that, I mean, our reluctance to go and finance that particular buying of the company. So any level as a lending officer, as a credit officer, for you, whether it is 100,000 facility, or whether it is a 5 million facility, or if it is a 500 million facility, or whatever, as a lending officer, you will first assess, have the first assessment, your gut feeling, your judgment, and all that. And if you are okay, only you will go to the next level of proposing a facility, and then you get all the information and then put that into kind of a proposal, and then prepare, and then recommend, and put, and all that process will take place after that, right? So that is about handling a particular proposal. One other thing I want to tell you is that relationship management and credit administration. The people who are working in the branches, you will find you are talking to the customer. You are getting the proposal, and you are getting all the information from the customer, and you are satisfied yourself that you can give a particular loan what the customer asks for. In the rest of the process, you go ahead, and the paper goes through, the proposal goes through the layers, the hierarchy, and then gets approved. So when it is communicated, you may be then sitting with the customer to take the security documentation. You will draft a letter of offer in the format. So this much of facility, and we are giving, these are the terms, these are the securities, these are the interest rates. The interest rates are whether it is a floating interest rate, whether it is a fixed interest rate, all that you will mention, and then you will get the all the terms covered, and then you sign and get the customer to sign. I agree with the letter of offer, right? Customer has to sign and agree. That's a legal document. A letter of offer is a legal document. Your offer should be accepted by the customer. Otherwise, what will happen is that if an offer is not accepted by a customer, he will later can say, he can default a loan. He can later say, I never asked for a loan. Right? The bank gave, I will not settle. There are cases like that also. It's funny, but there are cases. And worst part is that a judge can uphold that. Where is the letter of loan request and then letter of offer? Those we will feel that, I mean, these are not very important, but those are very important. Customer has to request, I want this much of loan for these facilities. Customer request should be there. There should be letter of offer signed by the customer. Bank is offering this many loans, this many facilities at this interest rate, at these terms. That offer letter should be signed by the customer. So you get the letter of offer, and then you will have general terms and conditions. Other general terms and conditions also you will sign. And then depending on the security what you are taking, that security you may have to take. Down the line we will see if it's a mortgage, how to sign a mortgage bond. If it is you are taking a shares as security, like how to take get the shares assigned to you. If you are taking let's say personal guarantees, how do you take the guarantees? What are the guidelines on taking the guarantees? So different securities, how to take and all that down the line we will see. So you have to take the security. Next line is you have to take the securities. Now that is where I am coming at. There are two functions here we spoke about. So the people who are working in the branches may not understand this. People who are working in head office may understand this. There's a difference between your relationship management and doing your credit administration job. Why I'm saying is that your relationship management goes to the level of talking to the customer and you getting convinced that you can give a particular facility, and you preparing proposals and putting for approval of the management, and then you getting it approved. That is, I mean, up to that is the relationship management. Then the other part of getting the security documentation is we call it credit administration. So the security documentation, like getting these letter of offer signed, or general terms and conditions signed, or mortgages or other securities you're taking, all that is part of the credit administration, right? So the approval will say, subject to doing these, some conditions will be there, subject to getting the customer to have a continuous build-up of savings amount, subject to okay, property, some issue is there, like I'm subject to taking the title insurance. So like, I mean, like that, there can be many conditions also can be there for the approval. Now, what happens is that a relationship management, or in the branch you are doing, it's natural that you always will try to give the facility faster. So in one way, you want to disperse faster so that you have a, for your target also you will achieve faster. So you can credit. So that the day you credit, your loan portfolio goes up. So the faster you disperse, you are achieving your targets also. Customer happy. Customer getting the loan faster is happy. So in the process, the credit officer in doing that may sometimes fail to comply with the conditions, fail to take all the security documentation. Let us say there's a delay in taking the mortgage. There's a property mortgage, signing, getting the lawyer's time, arranging the mortgage to be signed and all that. It is getting a little delayed. Now, if you have the power at the branch, okay, this mortgage will be signed on 10th. Now today it is the 1st. So by 10th we can sign and okay, so I will go and disperse the loan. Sometimes people can, with incomplete security documents, can go and disperse the loan, right? Can go and disperse the loan. And your facility, I mean, proposal approval may be there. It might say, once in 3 months, you must do a stock inspection, and then stock inspection report should be filed. So you are supposed to do once in 3 months stock inspection. Sometimes you may not do, right? Okay, I'm happy, loan dispersed. I have to run behind other new customers to disperse loan. I mean, me going and doing a stock inspection for an existing customer is not going to add to my portfolio. So sometimes there may be, you may neglect, there may be negligence on your part, not doing that particular stock inspection. There may be, vehicle under mortgage or vehicle lease or something. You need to take ensure that insurance taken on time. Maybe you may not take the insurance policy not renewed. Customer also, without checking that, he runs, right? Until police catches him, he is not bothered, he runs, right? And if you haven't ensure that insurance policy is renewed, it's a big risk. If the vehicle meets with an accident may end up in partial damage to the vehicle or full damage to the vehicle. At that point, you can't claim from the insurance company. No insurance. So when you can't claim from the insurance company for the damage, your loan is not covered. It becomes unsecured, right? Maybe it may be lease, or maybe it may be vehicle mortgage. So all these kind of things, whether it is mortgages or whether stocking inspection or whether it is the insurance, or all these, while you are handling the whole entire gamut of affairs, there can be chances that the people who are looking after relationship management may omit these things and put your organization into kind of a trouble, right? Loan may become exposed, right? So that is where I'm talking about relationship management should be separated from the credit administration. The people who are doing credit administration, that is taking the security documents, taking insurance policies on time, doing stock inspection, looking at the repayments, like whether loan is repaid, whether one installment repaid, pending, 2 installment pending, following it up, and giving MIS, all these part of thing which prudent practice may be to separate from the relationship management, right? That's what I call credit administration. Relationship management being separated from the credit administration, so that Those guys, though, they don't know about the customer. They don't, I mean, they know about the customer. They don't interact with the customer that much. They mechanically will do. They say, okay, insurance not taken, take it. We have to debit the account. I mean, debit the account and take the, even overdraw and debit the account and take the insurance, because insurance policy renewal is more important than other things. And stock inspection, timely done, filed, and then report given, right? One installment overdue, call the customer. 2 installment overdue, give the report to the management, other people also, keep the relationship management informed that the customer is not settling. I mean, proactive measures can be taken by these people who are only handling the credit administration. So the prudent practice to avoid the risks, to avoid the credit risk or any other related risks, having credit administration separately is better. So now you all tell me, how many of you in your organization have this setup, whether you are doing together or you are doing separately. So tell me whether you are doing together, relationship management, the credit administration, you're doing together, or you are having a separate setup doing that. You know, you only do look at until you book a loan, and then all the security documents, and then follow up, and then completing insurance related, inspection related, and all that kind of things, follow up, and the loan repayment done separately. So type, say that. How do you all do? It's done together. Ajipan says it's done together. Yeah, in branch setup it is done together. But do you understand the risk in this? Do you understand the risk in this? Because the relationship, when we are doing the relationship, we always try to, even with, right, done together. Yeah, together, but checked by independent department. Maybe you will have some internal audit setup, continuously check on that. Okay. Okay. Right. Who else? Only 3 students? Yeah. Adhikari Kumara says separately done. Great. Dilan Atapattu says done together. Yeah, normally, yeah, branch staff have to do everything together. Yeah, correct. I understand that. In the branch, that issue is there. You can't, you can't afford to have many staff doing 2, 3 different functions. So you do together. That happens. Yes, branch staff have to do together, to do everything together. Yes, anything else? But if, we can also have in the branch, one staff work and checked by the other, something like that. We have separate units. Shanali says we are separate units. Great. So, yeah, do you understand the gravity of this? Gravity of, if you are doing together, you need to be extremely disciplined, right? Many a time what happens is, when this is done together, many a time what happens is that any security lapses are identified only when the loan is defaulted, right? Security lapses are identified when the loan is defaulted. So, for example, I can tell you, I was going to the ombudsman on a case. The lady comes and says that currently I am not with my husband. Probably they are going through a divorce proceedings, and she says that my property where the property is jointly owned by me and my husband, and my husband has mortgaged the property to the bank, and he has taken loans, and the loans for the company where he is the managing director. So for the company he has taken loan, he is the managing director, mortgaging the residential property of the managing director, where the wife is a joint owner. And what happened? The loan is defaulted and the bank is trying to take action to see that the wife has not signed the mortgage documents as owner. So the bank is exposed. Bank is exposed because a mortgage document should be signed. You have something called mortgagor obligor. Now, when it comes to a company is the obligor. Company is obliged to pay the loan, right? Company is the obligor. So obligor is the company, and the property which is mortgaged is the husband's, the managing director's property. So the managing director is a mortgager, right? So when you are lending to an entity, you need to have this mortgagor obligor clause where the mortgager, if there are other owners of the property, they also should sign, right? So the lawyer has made a mistake of not getting the joint owner signing the mortgage. So now when you are going for recovery action, there is a flaw, there's a lapse. Bank cannot go and enforce that because the joint owner has not signed the mortgage. Do you understand? These are, I mean, this can happen in a branch. In a branch, this can happen. Right? So that is one lapse I told you. Like that, there are many lapses. There are many lapses. I can keep on telling you issues which comes to light only at the point of going for recovery action. Until then, no problem. Now you with a insufficient security documentation, if you are given a loan, until the loan is paid, you have no problem, right? The moment the loan is not paid only is the issue. Okay. So that's what I am talking about, having the separation between the relationship management and credit administration. So a lot of branch staff, you all told that, I mean, those are done together. That is okay. But even within the branch, the system can be tweaked a little bit, where let us say there are two relationship officers or two relationship managers are there. They are handling the customers. So what you can do is that one person's credit administration work can be done by the other party, other relationship manager. So like that, not to handle the same party not handling, the other party can handle that. Like that also we can ensure some sort of impartial handling this, right? And then we spoke about need for the multi-layers, like, you have, depending on the delegated authority in your institution, you will have multi-layers. Whether, lending officer, manager, assistant manager, on top of it, senior manager, or chief manager, or regional manager, and assistant general manager. And above that, when you go, let's say, deputy general manager, you have chief operating officer, or you have CEO, chief managing director, or the executive credit committee, or the board credit committee, or board, like that. I mean, you have different layers. The need for that is that to have four-eyed principle. Four-eyed principle is what? Low amount means people down the line can approve. The more the amount, the better many people look at it, so that somebody can identify if there is anything which we haven't looked at, right? So that's the important thing. So lending authorities we looked at. So these are the things we were talking about. Basically, the board level credit committees, right? So top to bottom, if you come, you will have the board. Board will have board meetings, and you have board credit committee, which is handling all the bigger facilities. which are board limit to board credit committee limit, all that will be referred to that board credit committee, right? It has to go there. So that's the next level to the board. And there is a board integrated risk management committee also is there, which is looking at the risks. So normally the risk officer also, your organization will have a limit. Above what amount the risk department should look at your proposals. So depending on your appetite, your portfolio, they will decide the amount. So above a certain amount, it may be 50 million, it may be 100 million, it may be 200 million. Above that amount, things will be referred to a risk department. So risk manager will have to, or the chief risk officer will have to, once it is gone through by their staff, chief risk officer may sign it off. Okay, he will look at it and he will ask questions. Why it is so? Why are you considering this industry is like this? Why are you considering this facility? And he will have many questions on the proposal. He will ask. So get this information and give, get that information and give. The competitor information is not sufficient. Try to give. So to the sector, how much we have, lent. So many areas he can ask. Then once his queries are satisfied, only the chief or risk officer normally he can sign it off. Okay, all right. So what is the risk level of this particular proposal? Whether it is a kind of a low risk or medium risk or it's a moderate risk or whether it is a high risk or whether we should deny this. So all that he can say. We should deny this because this is area where we don't, the bank has a policy not to lend. So the refuse this, decline this facility. All that he will mark and send. Based on that only, further action on that particular proposal will be taken up. So the risk management or going through the risk management committee is very important for proposals based on the threshold set by the particular bank and financial institution, right? And at the corporate management level, we'll have committees. These are not mandatorily every institution should have. They will have their own, kind of committees, different. So but then the structure will be like this, something like executive credit committee. So which will have top 2-3 executives who are in the credit line will be part of it. They will have to approve. So all the papers which are going to, let us say, board credit committee or board, executive credit committee members will sign. They'll sign and put it, right? Executive risk management committee, right? They will look at all the risk side of credit market and operational risk side. They will look at, and there'll be a credit policy committee. So the credit policy committee will look at periodically looking at the credit policy, seeing the adequacy of the credit policy, changing the credit policy, right? Making amendments to the credit policy. All that will be done by the credit policy committee. So these are management level committees. Right? Any questions you have up to now? Yeah. Anything you would like to clarify up to what we discussed? Okay, we will have to look at the loan policy. Shall we go for a 15 minutes break? Okay, we'll go for a 15 minutes break.
Okay, sir.
Yeah, so we will come at 10:50. Yeah, 10:50. Okay. As far as credit is concerned, the advances are concerned in a bank, I would say the single most important document for your organization is that a loan policy. Now, why a loan policy? It is a policy regarding the advances for the financial institution. So now this can widely vary between organization to organization. For example, let us say you are a bank with a large portfolio and a very stable bank, very old bank. Then what happens is that your appetite will be little bit prudent and conservative, right? So to which sector you will lend, to whom you will lend, all that you will have a kind of appetite which might be different from a new finance company which has come into being, or new bank which has come into being. Now, if there is a new finance company, a new bank which has come during the last, let us say, 10 years time, it's so difficult to, compete with the existing competitors in the market. It's so difficult to compete and then get a portfolio built up, complying with all the requirements of central bank, having a decent enough business done and then show the profitability and all. It's a Herculean task. So sometimes the risk levels, they will go a bit low, right? So as you see that, there are many finance companies, if you see, they finance three-wheelers. So three-wheeler financing, we are going to a mass market and then doing that. So it has its pains, in the sense you are going to the mass market and then dealing with the customers buying and running three-wheelers. The amount of follow-up you needed, amount of paperwork and follow-up needed, and all that can be daunting. But still, for all, there are other considerations, and you need to have a business. We need to have a profitable business, good turnover, good margin. All that has to be there. And then maybe even if a few three-wheel, leases, if it goes bad, also is not going to drastically affect the loan portfolio of the finance company, something like that. There are many other considerations for deciding on choosing the thing. So if you look at, let's say, frontline banks, like whether it is People's Bank, Bank of Ceylon, or whether it is commercial bank, HNB, Sampath and all that, maybe their appetite towards that sector will be less. They will not do that much, right? So that is credit appetite. So every organization, to what sector we will go, how much we'll get exposed, what is our risk level, all that will be different. So where you will find this, you will find in a written down policy document, right? In a loan policy, it will say that this is the loan policy of the bank, this is the loan policy of the institution, and then these other do's and don'ts all will be defined there, right? So let's look at loan policy. Now there are many banks which will have a kind of a dual policy document also. One is that loan policy which is for a period. So that will be kind of not for a period, I mean to say, that will be a stable document, and infrequently that amendments will come into being when there are major changes in the policies take place. That's a loan policy, credit policy, or loan policy document. Then you have lending guidelines. Some of the organizations have lending guidelines which is tagged to this particular loan policy. The lending guidelines will have frequent changes. Like every time central bank comes out with a particular change, let us say that time in the lending guideline, like a central bank says that what are the imports, vehicle imports are there are luxury items or imports, there's a restriction. Lending to this sector, there is a restriction. Like, I mean, when kind of, on a continuous basis, when there are changes which are taking place in the market, to reflect that you have lending guidelines. In the lending guidelines, you keep on changing. And policy related, credit policy related things, which are actually emanating from the lending guidelines or from the market, which are of long-term effect, you go and change the credit policy. Yeah, amend the credit policy. So when you have that kind of a document, like, I mean, whether it is a lending guidelines and the credit policy, means these two are lending guideline will be a supplementary document to the credit policy document, and lending guidelines will frequently change, and any policy level changes will reflect in the credit policy, right? So that's how these policy documents are handled. So what is the purpose, right? Actually, a lending policy, a loan policy or credit policy, that sets out the direction. What is the direction this organization will go, right? What is the credit culture? So what is the lending philosophy of this bank, right? So those are spelled out clearly in the loan policy. So that will clearly say that what is the risk appetite, what sectors are encouraged, what sectors will go on a moderate exposure, what sectors will go kind of a discouraged sectors, where, like, I mean, due to some other compulsion we give, but then it's a discouraged sector, not everybody we will go to, something like that. So in that, the risk department also time to time will tell what are the high risk sectors. For example, now they can say certain sectors has high risk under the current situations, certain sectors has high risk, certain sectors has moderate risk, certain sector as a acceptable or low risk areas. So that kind of direction from the chief risk officer also will be reflected in the lending guidelines, and which is connected to the loan policy. So the description of policy level procedures for lending, maintenance, monitoring, and recovery of advances will be described in the loan policy. So what areas we'll have to look at for lending? What is the minimum requirements? Sectors, how do you maintain? So if it is kind of a how do you treat when there is one installment overdue, when there is two installment overdue? When if you find what is your policy if somebody who has taken a loan, who has that loan not settled, and that is written off, and then that particular firm or individual comes out in another form to get a loan? What is your policy? Is it like it's an undecided customer, totally right, or any qualification there? That will be spelled out, right? How do you handle this? How do you monitor? How do you recover advances, right? What are the infrastructure you have? How do you recover, right? In recovery of advances, what is the infrastructure? What are the approval processes, right? Different approval processes. In writing of, what is the process? In taking security, what are the acceptable security? What are the not acceptable security? What are the securities which are considered as good securities? What are the securities which are moderate? What are the securities which are kind of almost unsecured namesake securities? All these description will be available in the loan policy, right? So regarding loan policy, something you must always keep in mind, that individually every organization will have a loan policy which differs from organization to organization, which spells out the entire infrastructure of the lending infrastructure of the institution, and which says that in how the approvals are done, what sectors are looked at, what sectors are not looked at, how you categorize the risk and all that, how do you do the approval process, how do you, what is the ethical policy principle you need to follow, what are the ethical policies of the bank which the lending officers should comply with minimum. And then once you decide and then go and approve it, post approval, what are the things to be done, what are the things to be ensured before you going and disperse a loan, after dispersing the loan, what is the post disbursement follow-up procedures which you will have to follow. In following up post approval procedures, what and what things should be ensured, and periodically what you should ensure. How do you kind of handle your defection of your portfolio? Defection of your portfolio is like, you know, I mean, how much. So then, how do you? What is your policy on recognition of loans for impairment? How the impairment provisions are being done? How what is the minimum standard in that? What policy you follow in impairment provisions? And I mean, all these, from the point of view booking a loan, to the point of complete recovery, or other recovery actions, writing off or writing down, all that is clearly spelled out with the infrastructure, in the procedures, in the do's and don'ts, in the loan policy document. So loan policy document, along with its affiliated other document like lending guidelines and all that, which really spells out a particular institution's direction in lending, right? It has to be covered. Now, one other important use of a loan policy you must keep in mind is that loan policy should be as elaborate and descriptive and specific as possible. Then only it will facilitate your internal audit department. When your internal audit department comes and takes your loans and then sees whether you're complying with the internal guidelines, with the internal circulars, with the internal policy. If the loan policy is very deep, says that, I mean, clearly says in this circumstance, this is what you do, this is what you don't do, and all that, it is easy for an internal audit process also, because they will clearly identify what are the violations, where you are complied and where you are not complied, in what reason. So you are not complied for what reason. So whether you have specific approval for not complying on a particular this one. So your internal audit process also strengthened if you are having a very good credit policy. Not only that, if you are having a good credit policy, you know that external auditors will come and do an audit on your lending. Central bank will come and do an audit on your lending. Central bank, bank supervision will come and do an inspection. For all of them, having a clear direction in your institution about the credit operations is mandatory, and that is good for the organization also, so that any deviation can be clearly identified internally by your people, your inspection department, your internal audit department, or externally any external auditors or central bank or anybody else coming and doing a specific audit. Also, it will be easier for them to identify whether you have complied with the rules and regulations, guidelines issued by the institution, right? So that's the importance of a credit policy or loan policy of your institution to you. Right. So on credit policy, these are important areas. I'll be testing you all, definitely. Any questions on credit policy? No lending guidelines. Any questions? Are you all okay with this? How many of you have seen your lending policy, gone through your lending policy, credit policy of your bank? How many of you? Have you seen? Have you gone through? Or like you are listening to what your superiors say and you do the things and all that. I mean, but then you don't know whether there's a policy like this. Yeah, go ahead.
Sir,
Yeah,
hello.
Dylan.
Sir, does bank has a one uniform credit policy or do banks have separate credit policy like credit policy for retail sector, for corporate sector, like separate ones?
Yeah, banks will have separate credit policies. Not that every bank will have same type of a thing, because that's what I say. You see, your banks, you know, there may be a relaxed credit policy. Sometimes your bank might have. Some other bank might have a very restrictive thing. It depends on the appetite. Let us take, I mean, one extreme situation. Let me tell you. For example, let us say Deutsche Bank. Now, Deutsche Bank's credit policy will be, they will be looking at the cream of the corporate sector. They will not go and do the lending to retail sector. They will not go and do the lending to personal customers in retail sector. They will look at the top of the list corporate customers, multinationals, because that is the appetite. So their credit policy also will say that. They will say that, I mean, this is what, I mean, we will not lend to these sectors. This is the sector we will look at, right? So, I mean, if you take a Bank of Ceylon's, credit policy, they cannot do that. These are national banks, and then they need to, a local, private bank cannot really, like that restrict, because kind of a national bank, you cater to all the sectors in the economy. So your credit policy will be like that. Are you okay, Dylan?
Yes, sir.
Okay. That's it. So that's about the credit policy. Like what I told you, credit policy may have affiliated documents like lending guidelines, which may have frequently been changing things which are actually affiliated to the loan policy. But then, whenever government policies are changing, some of the new restrictions are coming, new relaxations are coming, that will be captured in the lending guidelines. This is about loan policy and lending guidelines. Okay. Now, this is a theory also in credit. We speak about the agency. Agency theory, basically what it means is that somebody acting as an agent for something else. If you see that, I mean, you have AMW Motors, AMW, like these guys are importing, let us say they are importing all Nissan vehicles, we importing Suzuki vehicles and, cars and other SUVs and buses and vans and all they import. I mean, they are an agent. They are an agent of, let us say, Nissan brand. So they act as an agent. So act as an agent, they have a agreement between them and the Nissan company. So according to the agency agreement, they will act. So they are the agency. Like that, you will find a lot of companies here operating as so for spare parts they are the agents, for BMW they are the agents, BMW spare parts they are the agents, like different agency arrangement by which somebody is acting in a country or in an area as an agent to somebody else. Within Sri Lanka also, let us say Ceylon Biscuits Limited, for them there will be agents around the country. They are only the people who are agent of this particular company to distribute their biscuits in the area. So agent. So that's called agency. Now in banking, what we call, in lending, what we call agency theory is that the executive management headed by the chief executive officer or managing director is the agent of board of directors. He is functioning as an agent of board of directors. Because directly he doesn't have the power, but he's the agent, right? He's the agent. He's the agent of the power. So by way of being the agent only, he is carrying out his functions. So the corporate management or the management and the board have this agency arrangement. So the corporate management is going to be the agent of the board in running the affairs of the bank, managing the affairs of the bank, as per the guidelines given by the board, which are spelled out in different policy documents. When it comes to lending, it may be credit policy, which are approved by the board, right? When it comes to risk policy, when it comes to assets and liability management, what we discussed, AML policy will be there. What is the assets and liability policy of the bank? How you all decide on, you revising your interest rates for lending? How are you deciding on revising your deposit rates? How periodically you will have these meetings? How you will borrow? Kind of all those things will be spelled out in the ALCO policy, like that AML policy, ALCO policy, all these different policies which are approved by the board. The management is running the bank, right? Management is corporate management is the agency of the board. So that's how the bank is run. So in lending, board of directors of the bank delegate the credit authority to the management, right? So the credit authority of the management, when given, the management they delegate the power down the line. So that is basically the managing director or CEO. They delegate the power, and after the line to the branch level management, the managing director delegates in sort of carrying out the banking business in a smooth manner, right? So that's about the agency theory. That's what we call it agency in the lending. So now, normally what happens is that in the management, many a time conflict do arise because the mandate of the board is that they look after the stakeholder interest. They have to look after the stakeholder interest. They have to look after the shareholder. They have to look after the investors, shareholders, public. I mean, that is their interest they should do. Sometimes there will be slight contradiction with the management, corporate management. The corporate management also, even though those considerations are there, corporate management also would like to see business should be sustainable, so that the employees also should be looked after, right? From CEO down the line, employees also should be looked after. So there may be some proposals regarding employee benefit or employees increase of salaries or giving other privileges or perks or promotional policies or creating cadres and all that. Sometimes board can differ. Board can say no, this will increase the cost. This can increase the cost. This can for the stakeholders this may not be good. So that kind of differences between the board and the management can come in sort of working together. Right, in sort of working together. So those are the issues which can crop up between the bank management and the board. Right. Hope you are okay up to that. Shall we go to the next puzzle? Next slide. Okay. Right. Okay, these are very basic things, but very important also. I find that even at the board level papers, sometimes some of the things are not given enough of attention, right? Due to various reasons. So in credit appraisal, at the preliminary level, at the credit appraisal, how do you go and appraise a paper? How do you go and find somebody who is bankable, to whom you can lend, to whom you are confident that you will lend and you will be able to recover? That's a basic thing. How do you identify a person? Just because somebody comes in, asks for a loan, I mean, are you okay? Okay, he looks, you know, he's a handsome guy, or is a pretty girl who is coming and asking for a loan. I mean, she will be able to pay the loan, no problem. I mean, can you consider like that? I mean, we don't, we can't go and see that. I mean, just because somebody is very handsome, just because somebody is behaving like a aristocrat, or because some girl is very pretty and attractive, doesn't mean that, I mean, we can go and lend to them, right? So that's why the credit is an art, right? Credit is an art. That's why while we were talking about delegated authority also, I said the delegated authority, when being given also, why the senior people, by way of grade or by way of experience, so given a higher delegated authority for the simple reason that, I mean, they have experience. Now, when this is an art, you need to, more experience you have, more better you will be in assessing people, right? So that's very important. So just after getting promoted, or just after being put to the credit department, you will not be given a DA to, you know, you can lend this much and all that. That hardly happens. People are trained in credit, right? People are trained in credit. That's right. People are trained in credit. You need to pick up your ABCD before you go and decide on giving a loan to somebody, right? Loan is as such, you know, even, I mean, it can be your, there are ample kind of examples. It can be your friend, closest friend. It can be your sibling. You may be your sister or brother, maybe a very close relative even. They can tell you that, I mean, give me 100,000, give me 1 lakh, I will give you return next month. I have this problem. Now you will know that, I mean, he's a very well-known person. I mean, he's a very close relative. You can't say no to him, and then you go and lend to him. And many times it so happens that 1 month gone, 2 months gone, 3 months gone, 6 months gone, 1 year gone, money will not come, right? Hope you all have this experience, right? Or maybe you all may be putting somebody else into trouble like that, right? So I mean, human nature. People, what they once, I mean, the people become different animal after taking a loan, right? They, until they take a loan, they promise sun and the moon. Once they take a loan, they are a different creature. Now, even for example, if somebody has taken a loan and then we have with discrepant securities, like what we discussed earlier, without getting an offer letter signed or mortgage signed, if you give a loan, after giving the loan, getting that mortgage signed or offer letter signed, it will be like you have kind of, you know, you are doing a favor to him, like. So he will say, I have this meeting, that meeting, I am busy, I will not be in town, I am out. Then it will be a big task for you to run behind, follow up and get the documents done. But before dispersing something, he will be there, he will be waiting with you to get that done. So this is the human nature, right? Human nature. This is the problem in assessing people. This is the problem in giving loans and recovering. This is why a very strong policy is very, very important. A strong professional credit management is very important. This is the very reason, if you see, the finance companies, many of the finance companies are failing, right? Many of the finance companies are failing because they are not strong in that. They do not have a strong credit culture, right? When the strong credit culture is not there, there are many people, they take things for granted and then they make mistakes that come back to haunt them, right? So, see, in all these theories what are spoken, I mean, we will look at this theory which is important for you. They put this character thing, right? Character thing, normally somebody's character is very important, like what I told you. Right? Yeah, I mean, I don't know what is your experience. In my experience, I have seen so many closer people who know for a very long time, very long period of time. I mean, they are different human beings. Before taking borrowing some money, and after taking the money, right? At a personal level, at a bank level also, it is like that. You can't, I mean, at the bank level, you go and do all the assessments and do, so that you may go wrong in a few percentage of the people, right? So they will be like that. So the character talks about somebody's payment history, right? So you look at the past experience, the past exposure, because of that you go and look at how has he paid the loans on time in the past. He has taken loans and then whether he has paid on the, so you look at the payment history. If there are delays, if there are delinquencies, whether you had to follow up a lot, whether it has gone into other actions, whether it has gone to mediation board or other courts or parate execution. The payment history is one thing which will show a customer. What is a customer? What's the character of the customer? Then you look at the credit reports, right? Crib you take. So where and where they have borrowed, how they are servicing. You find from the crib report, crib information given to you. You get from the crib, and then you find that, I mean, what is the history of this particular person, right? Whether he had been, kind of delay in settling the commitments and all. It shows the character. And see, while discussing also, you will get that kind of information from the customer. Can say, okay, I have a very good business, I'm getting a very good turnover, and then I can pay it on time and all that. But then from the discussion, it may be a different story. I'll tell you a story which is interesting, which was at the beginning of my, I mean, early part of my career when I was a branch manager. A youngster came and then he was very friendly with me, and then, I'm also young. This guy also is a young guy. He was, doing business, and then he was, his father had given a business and he was running, and then he was actually exporting tea and then exporting bulk tea and then packaging it in Middle East, and exporting vegetables. Vegetable items and all that. I mean, buying in bulk and packing and exporting to European countries and all. He was doing, young guy. So I was impressed with his dynamism. He was dynamic and then does things and then all that, and then whatever little advances I give casual and all that, he settles and all that is fine. So he was going on, and then we were looking at a particular proposing a facility. So we were looking at a particular amount. I mean, this much of facility for his we need to have these what do you call DA documents, collection basis. He will export, and then those payments will come until the payment come to discount those DA documents and then advance him, and then so that one limit, and then working capital some facility, all that. He wanted. This happened maybe about say about 20 years back. At the time I was a branch manager. Then so I took him to my regional manager. Regional manager is a senior fellow. He was in the bank for quite some time, and then he was senior fellow. I took him, and then he told his name was a little funny name. So when he told the name, his surname, when he said, my regional manager was asking whether what's his father's name, and he told his father's name, which was connected to this particular surname, and then he said, I mean, whether your father is doing business, and father is now of course very minimal, and then I'm carrying out the business and all that. This young chap said, and then so we discussed about the facility and came back. We never gave a word, and the customer went. So when I came back to the branch, my regional manager called me. my regional manager called me and then he said, Prabhakar, you got to be careful. I said, why boss? It seems to be a promising business. I can see the turnover. I can see the way this guy is operating. And then he's a dynamic guy. And then I find that I'm confident that he can do a good job. And then we can bring this customer up with the. He said, careful. I know about the background of the father actually took a facility from the bank and then defaulted. And then due to a security lapse from the part of the bank, in the courts, we went for a civil proceeding. The bank lost, then bank had to write off the facility. So the father is not a good customer. So you be careful with the son. And that was an insight to me. That was an insight because, I mean, until then I was not thinking about those things. Now, yeah, you know, like, I mean, people can do that kind of a thing. Like, I mean, father is like that, where the son is, can he default and all that kind of thing. But anyway, to be on the safe side, somehow I managed and I never gave the facility to the customer. So this particular customer was actually, he was occupying a 4-acre land in that area where my branch was there, 4-acre land. That land was given by another bank. Another bank's facility, defaulted facility. That defaulted facility was for a sugar import, and then sugar import, then some problem, and then that customer defaulted. So that property was acquired by the bank, and then that property had been given to these customers, and then these customers were, what they were doing, the young customer whom I am referring to, young fellow, what they were doing, they have undertaken over a period of some 7 years or so, they will pay on a loan given to them, and then at the end of the period of paying the loan, they will get that 4-acre land. So on that way only they have a factory arrangement and then packing for export and all that they were doing from that particular land. So what happened was, that particular bank, the other bank, which has given the land to them, which has given the loan to them, that after paying the loan, they will get the ownership of the land. Their repayment of the loan was coming by way of discounting these DA documents. So they export tea to Middle East, to their own facility in Middle East, and DA document they come and give, that is discounted, and from the discounted amount they settle, you know, loan installment, and when the payment comes, that particular you know, that part advance is covered, whatever amount advanced by the, you know, discounted amount is covered. So it was going on like this. Now after that I learned, after some time, payments were not coming. For DA document discounted, payments were not coming. The payments were not coming, and then so that loan not getting settled. I mean, in the sense, I mean, they were discounting 2, 3, 4, 5 bills were discounted, money taken, loan also settled, but then this particular suspense account balance is there, payments are not coming. Then, of course, they started checking whether the document what they gave and discounted, whether they have exported the tea to Middle East. When it was taken and investigated, when it became a police case, when they checked up, it was identified that these guys were giving false documents to discount. After some time, they were doing earlier, okay. After that, they were not doing, and then they were giving false document, getting it discounted, and all that things were going on. And they never expected them to go to police and CID and you know, customs. They will check, and then they came back, and then the bank took action. Bank management took action. When the bank management took action, these guys, they actually ran away. They ran away from the country, and the DGM of that particular bank, who facilitated by giving a loan for the land, who facilitated by discounting the bills, he was in trouble. He was arrested and put behind bars. He was arrested and put behind bars. These guys ran away. Now, when I learned that, after a couple of years only, I came to know the wisdom of my regional manager. He said, Prabhagar, the customer background is not good. Right? He has done this because he knows that he has taken a loan, he has to settle, but he did not settle, and we had to go for a civil case. In the civil case, because of the security lapse, he escaped without paying. So that is not a good customer. So you don't trust the son also. I mean, that particular wisdom, I learned when I heard the story. I mean, the total fellows were, I mean, they were out of the scene. They left the property was acquired by the bank again. And these guys were out of the scene. They ran away. Father and son ran away. So this is about the character. I just wanted to give an example to you. This level, the character of the people is very important. Now, when I go to, when I was posted to Bangladesh, and then there I was a chief operating officer as well as the country manager after some time. For about 5 years, I was a country manager. We were doing with huge loans. Like, I mean, those loans are very big, and then big factories, big operations and all that. So when I go and see, when customers approach also, we have, people, huge malls. We can't find that kind of malls here. Malls of 140,000 square feet area, like, I mean, that kind of malls, the entrepreneur who has put that kind of a mall, he was asking for a loan, but one senior fellow from my, staff, he said, I'm not comfortable in, going and recommending a loan to that fellow because he has a bad background. He is rich and all that is fine, but he is not a good paymaster. He has defaulted banks. So that wisdom I depended on, never gave. I never gave. So we depend on that. So that character is very important. Character, like, I mean, we'll have to go behind. Character speaks volumes of a person's repayment, right? That's very important. People may be very rich and then having multiple, like, I mean, having company kind of things also. The people's character, how they have behaved in the past, we call it the habits die hard. The habits what they have got, it can continue, right? The character is very important. So then the capacity, that's what I was earlier telling you, some example also. Capacity of a person, be a borrower's, source of repayment is very important. Unless you are convinced with the source of repayment, any amount of security is not going to do any justice for your lending, right? So just because a valuable security is there, it doesn't mean that you can go and lend to a person unless that person has a proven repayment capacity, right? So the capacity to repay a loan is very important. And the other one, what we call about the capital, is that the borrower's equity contribution, how much they put, that is their commitment, right? That is their commitment. Even for a non-personal account, even for a company, when we are putting that time in, the more the equity is, the more the interest is. What happens is the customers, if they find that, I mean, fully we can finance from the bank, and then fully, I mean, they will think that, I mean, the business makes profit, okay, we'll pay the loan. If the business doesn't make the profit, we will not pay the loan. People, if they are lower in their ethical standard, that they will do. In my experience, I have come across many of the people, people come and ask for a part of their business, one of their subsidiaries. So one of their factories, one of their sub operations, the group as a whole may be doing well, but when they ask for a particular facility for a particular sub operation, for a factory, for a part of their business, now you go and assess and see that, I mean, this customer is very good and all that time, do the complete group and subsidiary operation, analyze, and then propose a facility. The person takes the facility. Then what happens is that if that particular company is not doing well, or the particular customer has siphoned off, or siphoned off in the sense, I mean, taken the capital from there to some other operation, right? Has not given sufficient, or things beyond their control. If that operation has not doing well, and if they are not able to repay the loan, I have come across many people who say that I have taken the loan for the particular operation, that's not doing well, I can't pay. There are ample, I mean, I have come across many customers telling that operation doing well, not doing well, we can't pay the loan. So we'll have to see. So you give some more loan to restructure, you restructure, reschedule, and you release the security and then go for some other security. Like that, I mean, they will give ideas for us to, go and plow more money into that business rather than they as a group solving it. So many customers we have come across, that is a bad sign. Yeah, they don't take ownership and then say, okay, we will have to, okay, now there's a problem. The thing, let's solve. Now from this, I will try to, pay the repay the loan, but do a restructure. But then somehow, until that company comes to a position, from the other operation, we will have an allocation to service these loans. That kind of things. Many times the customers don't do. That's about the character. That's about the character. They think that, I mean, that's bank's headache. Bank gave the loan, the particular operation not doing well, that's not our problem, right? That also is about the character. And then that's about the capital also. How much somebody is contributing towards it. This one. So for you, the collateral means is a security, right? Collateral basically in any event is a secondary source of repayment. For advance what you give anything, I mean, that's a secondary source of repayment. That's a fallback scenario. So that is why a banker will not fully depend on a security to give a loan. Banker will always look at what is the cash flow. If it is a salaried employee, whether 3 months salary has come to the account, they will see that, I mean, what is the spending pattern. I mean, whether they have a steady, they have a steady saving, or like, I mean, some part of their income is kept in, or like, I mean, after paying other loans and other commitments, they have the part which can service the loan. That part the bank will have to convince. For a company also, it is the same thing. Like, I mean, from the cash flow, after meeting with all the other commitments, whether they have sufficient, when we are looking at the cash, ratios, different ratios also we will look at. That is basically what we will see, whether they have sufficient cash flow from their operating income to service the loan, right? So that's the primary thing, your repayment capacity. Then comes the collateral. Collateral is that if due to customer's negligence or things within the control of the customer or beyond the control of the customer, let's say due to COVID lockdown, COVID-19 lockdown, many businesses were closed, no business, person fell into trouble and unable to recover. We gave moratorium. After moratorium also unable to recover. Then it goes into the secondary source of security is the collateral, right? And then that collateral's quality of the collateral is what will keep you in good state, whether what is the nature of the security, what is the market value, where it is located, and all that will be your strength as a collateral. Sometimes, let us say, we are giving a machinery mortgage. We are going in financing for a government factory. We are taking a machinery mortgage and then giving a facility for purchase of machineries. So machineries are purchased and then installed, and then factory was running for a couple of years, and then now due to this problem, the factory closed, and then now you are, let us say, we have come to the verge of acquiring the factory and then selling the machinery. Repayment, the resaleable value of the machinery will be far less. Even though machinery has a value, who will come and buy, right? Even if you remove the machinery and sell low, even if you sell the factory with the machinery, the resaleable value will be much less. It will be very difficult, right? So the collateral quality is that. say some exotic equipment. Let's say somebody has put a kind of a state-of-the-art bakery, and then brought state-of-the-art equipments, and then set up the bakery, and then he was running. So we have finance the bakery equipments, yeah, all latest. Then let us say something happened now. You could not continue the business. No. Then if you are acquiring that and selling, I mean, the price what we can get for those bakery equipments maybe 100%. If you have finance, I mean, maybe 20% or something. People will not come and buy. Market, who will buy? What is the, how many people can come and bid for that and buy? It will be much less. I mean, people doing business and all that, and then on the off that, who will have the appetite to go and buy a latest thing and then run and all that kind of thing? I mean, the appetite will be much less. So those are all lending where we, look at the customer profile and lend, even though the security is not that strong. But if the customer has fallen, not doing well, that collateral almost comes as a namesake collateral. It may not, settle your loan. No, very small part of your loan only it might settle. So that's about the collateral. Then the conditions for also very important. Now you are going through certain economic conditions, right? So where it is going to be economic conditions. People who have been, thriving on, that a lot of finance companies, kind of leasing companies and all were working with the vehicle agents, smaller, big vehicle agents. Even there were certain practices like, vehicle agents, the financial institution, they give a commission to them. They give a commission to the vehicle agents, and then so for giving leases. So leases are, so that particular vehicle agent will book all the leases in that particular finance company, so that they get an additional commission from the finance company. Then leases are booked, imported vehicles, brand new vehicles, or second-hand vehicles, all that done. Now you see for the last 6 months to 1 year period, it has become a big issue. So the finance companies dealing in those things will have a bigger hit, like the condition, economic political conditions, how the tax law will change now, right? How it is going to affect. These are all important, right? So the conditions, economic and political conditions, but in the market, which has a bearing on the market conditions, which can affect the borrower's business. So that has to be taken into account while you are doing the credit appraisal. You can't say pre-COVID it was like this. Okay, and post-COVID you will have to think of when you are going and lending now, right? After COVID, the period how this business is going to fare, you must be careful about that. In the cash flow, right? The other one is cash flow, right? What is the cash cycle? What is the working capital cycle? What is the liquidity position, right? There may be people may be having very good assets, but they may not have liquidity, right? All doing on credit basis. People are doing on credit 90 days credit basis, and then they are getting only say 30 days to 60 days from their suppliers, and they come for working capital facility. So eternally they will need working capital facilities. They will keep on increasing because they have a bigger sundry debtors. I mean debtors in their portfolio, receivables in their portfolio. So when they have the higher receivables in their portfolio, that is building up because of the mismatch between the credit period given to the suppliers and credit period they give to their customers. There may be liquidity position problems will be there. Now how to solve it? Before we going and doing lending, we must know, we must match it, whether we are matching the working capital requirement for that period, and then whether age analysis is okay. You will have an age analysis. They let us say somebody can say 100 million I have to get from my customers. So if it is 100 million, if you find 50 million is due for more than 1 year, then it's a major problem. You say 100 million due, that's fine. I mean, you are going to get the 100 million, but then you say you are giving 2 months credit period, but more than 50 million due are there for more than 1 year. So people have not paid. So if it is more than 1 million, whether that 1 year, whether that fellow will, out of the people, owing 50 million, how many people will pay that after 1 year, right? So you will have a problem with the liquidity in the cash cycle thing, and then blindly if you go and finance the customer, we will get sucked into his his way of operating, and then our facility subsequently will not be serviced. So here actually we looked at these are easy to remember, like theoretically easy to remember for you. 6 is okay, character, capacity, capital, mother condition, collateral, cash flow. But then while you are doing the assessment also, credit appraisal also, you can subconsciously look at this and then see whether you are covering these areas, whether it is there, because these are the things, these are true for 100 years back, true after 100 years also, right? So different ways of identifying. Now here we are talking about 6 C's, and then now we are talking about here we famously call it Campari. Campari, mnemonic for this. So that also starts with the customer's character of the customer, ability to repay, margin of profit. That is, what is the margin you keep? Now, what is your cost of fund? We spoke about cost of fund a lot at the beginning. What is the cost of fund of the bank? And if you're going in lending, let us say at current market condition, you are lending at 8%. So if your cost of fund is 5%, you have a margin of, your margin of profit is 3%, right? The purpose of the loan is always important. You need to know what is the purpose for which given. If somebody comes and says that I'm a drug peddler, so I need to acquire stocks. Of course, in your credit policy, it will be there. We cannot lend to illegal purposes, right? So drug peddler is doing an illegal business. You can't go and fund it, right? And then let's say somebody says that okay, for companies like CTC, we are going in planting tobacco. So tobacco farming we do, for that we want a loan. So you may have in your credit policy. So doing contract farming for tobacco and all of these are kind of a social taboo, or else which is affecting the society, which is like tobacco is not good for the people. So that you may have sometimes in your credit policy telling that people who are doing farming or contract farming, growing tobacco, bank should not lend, right? Bank should not lend. So that kind of, purpose of the loan is very important. Housing, okay. Sometimes when you look at, let's say the condominium sector, lot of apartments, they are finding it difficult to sell their condominiums. If it is so, your risk department will rate that as a high risk sector. They will say high risk sector. If they say that it is a high risk sector, they will say we put a limit here, right? We put a limit here. We'll say that this sector we will only expose up to this percentage of our total loan portfolio. Let us say your total loan portfolio is 500 billion. Out of 500 billion, they will say, now we will not exceed 10% of our total portfolio to this sector, say for condominium sector. The 10% means 50 billion. So your lending policy can restrict, telling that only 50 billion only. You look at the portfolio, what is the exposure to the condominium sector? We have given loans up to 49 billion up to now, means the approval can be given only up to another 1 billion, right? More than that, of course, it is an exception. It has to be referred up whether we can give or not. So like that, the risk policy also can restrict. Okay, what is the sectoral exposure? Is there a ready-made garment? Factories are producing ready-made garments. You can say that ready-made garments, they are finding it difficult now under COVID situation. Exports on time, they are not able to export. A lot of overheads, payments are not coming on time. So we are going to restrict exposure. We will not take any new ones. Existing ones, somehow they will manage and go. Like that, it is on the purpose of the loan, whether that is in line with the bank's policy is very important. Then amount, of course, while deciding the amount, it's very important. You are not giving one cardinal principle of lending is that you don't give less or more, right? For example, somebody is putting up a factory and he is asking for, telling that 125 million factory, 100 million please finance, and 125 million I'll put the factory. And he gives the cash flow projection to you. Okay, after putting up the factory, I will take 6 months to put up the factory. And within 1 year, this is the turnover I will achieve. And the cash flow is going to be for the future years like this. And then this is how, so give me a two-year grace period to pay the loan. Initially, I will pay only the interest to you. After second year, my production will be sufficient enough and the turnover will be sufficient enough to service the loan. I will service the loan. So you will give a plan like that. Based on that, let us say you are looking at. But your management goes and they say that, okay, it's a new customer, we can't get exposed to this much. We will approve only 75 million. You approve and give 75 million to the customer. Actually, he wanted 100 million, right? So he has 25 million. You gave only 75 million. His requirement is 100 million. He actually depends on you for, 100 million. Now you have given below the requirement. Now what the customer can do, without that additional 25 million, he can't complete the factory, right? He can't commence the business. Then what will happen? He can go and borrow from from somebody at a higher interest rate. You may be giving an interest rate of 7.5%, 8%, but when he goes to a money lender, informal money lender, finance company, maybe they will have to pay about 15% or more than 15% for the 25 million. But then this guy wants to start the business, so he goes and gets that 25 million also at 15% or more than that, and starts the business. Puts up the factory. Now what will happen is that his cash flow projection will be affected because he never projected that I'm going to get 1/4 of my loan requirement from a money lender, and I will pay a higher interest to him. So the cash flow will be affected, and he can be affected now. Like because he has to pay, the profitability is not sufficient. His business will be affected. He may be drawn into further mess, right? So all the projection what was given to us also can go for a go to a mess because we have not properly assessed and given the right amount to the customer. We have given him low, so he got exposed to a high interest rate scenario, risky borrowing, and that is pulling him into other cash flow issues, which eventually is going to badly affect the business, which eventually is going to badly affect the repayment of our loan also. So do you understand the problem of giving below the requirement? So you need to assess the requirement. How much he actually wants? What is the purpose? How much actually he wants? So if you are giving less, also problem. If you give more, what will happen? Part of it he can go and buy a car. He can go and put partly and then buy an apartment. He can go and buy a car. Then expensive car he can go. People will be saying, oh God, this guy he's putting up a factory, he is going in a BMW, going in a Benz latest car. So people will be telling that, okay, he's a rich guy. But the problem is what? We have overlent so that he has misused the funds. When it comes to repayment, he will have a problem. Because this money, what he has gone and invested lavishly into some other property, which is not going to give him any cash flow. which is only my ego massaging for him, right? Showing ego that I'm so and so, I'm a factory owner, I'm a BMW owner, but not going to really contribute. I mean, if he has a problem, he's going for a loan of 100 million, and then going and putting up a factory, and the incidental expenses, overhead, everything he has to look after, not yet commence commercial production. He going and getting into a higher asset which is not going to yield anything will pull him into problem. So there also you have an issue, because it is you who went and gave a higher loan to the customer for him to go into a lavish means, right? So lending officers need to be very careful about how do you decide the amount what you are going to give to the customer, whether you are giving less or whether you are giving more, right? Giving less also problem, giving more also problem. So the art of credit, your expertise depends on how do you decide how much to give, right? How much to give is very important. Now, in the same way, let us say John Keel's Holdings or Haley's or let us say Atkins Spencer, they are coming and asking for a loan, and then you are giving, you are telling that, okay, you are asking 5 billion, we can't give you 5 billion, we will give you only 2 billion. Okay, if you give only 2 billion, they have the clout to go to other banks and get the rest, not a problem. Professionally run entities, companies, they will not misuse the funds. They will not, just because they have the funds, they will not go and invest. They will know how much they want, only that much they will borrow. And because that is the very reason the corporates will rely on corporates more than the individual or small businesses. Those corporates, for their name, to keep the name, they'll be very careful. There will be enough of chartered accountants looking at that. There will be enough of management accountants employed by them. They will keep on insisting, right? Keep on insisting that, I mean, professionally we'll have to run this, we should not overborrow, we should not underborrow, we should not misuse. If you don't have a project, we should not go and properly evaluated project, we should not go and invest. All the time they will keep on insisting on that. So that is the comfort, right? So that's for professionally run bigger corporates. So mid-level companies, when you see family-run companies and all that, that's a problem. People find the money, they will say, oh, excess EA is there. Bank, you don't have to pay now, is installment basis, let's enjoy, right? So this happens time and again, time and again. If you go back and check, you will find that, right? And repayment terms, also you will have to have the repayment terms properly set up so that your repayment is going to be feasible for the customer. So you're looking at the cash flow, you are looking at the ability to pay the interest, you are looking at the possibility to pay the capital part, and with the cash flow easily you can pay. So for these, even in the accounts, you are going into ratio analysis. You have enough of ratio analysis to be done in identifying the liquidity and repayment capacity. So that we will look at subsequently. So repayment terms you will look at, so that you don't go and say that, I mean, okay, we are giving for the factory, you will do 5 so customer cannot go for 5 bullet payments of 25 million and then pay, because I mean they are not generating that much of cash flow. They will not have that much of operating profit to do unless they do some capital asset selling, right? So that's about the repayment terms. That's important. And insurance against the possibility of non-payment is what, I mean, here it is spoken about the collateral what you are taking, right? Insurance is the collateral what you are taking. Like, I mean, if there is non-payment, what you do. So this is compare also is a policy, but you know, credit appraisal. I mean, these things, 6 C's, 5 C's, 3 C's, compare and all that, you keep it in your mind. It's important. While you are doing the credit appraisal, you can just cross-check and see that whether you are covering these areas. Because that just simply covers the customer, entire gamut of operations of the customer. So like that time, you know, character, capacity, capital, we call it 3 C's, and then 5 C's, you know, the other 2 C's what you looked at will come here, and then CCC parts, CCC parts correct. The parts is like, you know, purpose, amount, repayment, terms and security, and then we call it a person, amount, repayment, security, expediency, remuneration. These are all expediencies that like, I mean, you know, they paying things on time, right? Expedient. And remuneration is like, you know, what is the return, right? Return from the particular lending. So different ways it is put. So end of the day, it is kind of covered in whether it is 6Cs or compare, it is covered, right? So this is about the credit appraisal. What are the things you will look at while you are doing the credit appraisal at a preliminary level? Any questions here? So I spoke at length for you all students who are people who are not doing credit also. For that only I spoke at length so that you will understand. Anyone, anything you didn't understand, you tell me. Or you say you understood. Are you all okay? Any people who are not doing credit, respond to me. Currently who are not doing credit or who have never done credit, who is listening to me, tell me whether are you okay? Okay, great. Madhuma, okay. Right. Shanali, okay. Right. Any, you all don't have any questions here up to now, what we discussed? I know that I'm going a bit slow here because those are the fundamentals. The people who have not done credit, of course, when we go down the line, you will find it difficult. That's why I was taking time and taking enough of examples to explain to you. Okay, you all don't have any questions? One of the important things for a lending officer, you must keep that in mind. Relationship, you know, your job is managing the relationship. That's okay. You need to you know, manage the relationship. There are many people, even at the level of manager, corporate management level, even at the CEO level, problems do come when you go in, because the customers can be a little under 1,000 you may be lending, or maybe you lend about 20-30 billion rupees to the customer. So it depends. I mean, on the particular proposal, and then on the customer profile. But for everything, the lending officer need to keep in mind that there has to be a fine line between you and the customer. While being close to the customer only, you will get the business. That's okay. So many other people will you know, go and then sit with the customer, have a booze, enjoy with the customer. That is okay. Not that I don't say that you don't go and the customer. Okay, that's okay, customer. But then at any point of time, when you see something going wrong, when you see that business there is a direction is wrong, or else you know, beyond the control of the customer, something is happening in the business, you should be able to, you know, tell that to the customer and the management. Here this is happening, this is happening, these are the you know, these are the mitigatory factors, mitigatory measures we must take. That if you are able to do, you are a good lending officer. If you try to go and tell the management, no, nothing, no problem, nothing wrong, or you try to hide those things and then wait, for a future day where it comes out, and then when they ask that why you did not bring this up to our notice earlier, why? So no, we thought the customer will be okay. I mean, that's a bad lending officer. That's a bad lending officer. So the impartiality with the customer, if you are able to maintain, that's a difficult task at the at the lower level lending officer after the CEO of the bank. The difficult task. If you are able to do that, only you are a good lending officer. If you are not able to do that, you are not a good lending officer, right? There are enough of examples for that in the market. In the market, I can talk about CEOs also. I can talk about people in the corporate management. I can talk about people managers. I can talk about lower level lending officers. We have gone wrong in that, and then put the institution into trouble, right? So if it is 1 or 2 loans, smaller loans, that's okay. But if it's a bigger thing, it's a major issue. People are put into trouble. So lending officer, that's what we'll call it, a healthy skepticism. What is a healthy skepticism? Is that you naturally will not accept everything customer says unless you independently verify, right? That is the healthy skepticism. You say customer says, okay, I have this cash flow, my cash flows will start from January, COVID situation is going to be okay by December, by January the vaccine is going to come, my sales will go up, my sales are going to be this many, I mean for January, February, March, April, like, I mean this is how my turnover is going to go up, my operating profit will be this, my earning before interest taxes and accruals and all that, my EBITDA is going to be this, so I will be able to repay my loan this way, right? My debt service coverage ratio is this. I mean, customer can tell to so many things. If you just take and say, okay, customer said this, if you accept it, you have not verified. So your healthy skepticism is that how much it is true. Now, if you go and see that whatever figures given by the customer, even pre-COVID, it was not the same, means, I mean, there's something wrong. Even pre-COVID, the turnovers were not like that. This guy is trying to tell us post-COVID, this is going to work like this, means he is highly ambitious, this may not work, right? So that part, independent checking, independent verification, independently, and then always trying to see to what extent you will trust the customer, to what extent you will take customer's word. It shows a good quality lending officer. What's your quality? So that's what I say, healthy skepticism. Now, why we are telling that, I mean, we will not go and fund somebody 100%. If he says comes out with a project of 100 million, we will say that, okay, 60 million we'll give. Why? Because that we always try to keep a leeway. We keep a leeway because what he says, we can't take it for that. So while you are talking to the customer, also it's like that. You don't go and put in your proposal, loan proposal, all what the customer says. You will put that customer informs this, but from our independent verification, this is what we find. So conservatively, we estimate the cash flow to be like this, which can be about, at times it can be 25-30% less than what the customer claims, right? So customer always assumes ideal conditions, maximum profitability, right? Even if the business is not doing good, so if you put yourself into a customer's position, it is the same. You will try to tell so many things which are very idealistic, which may not be, in reality, it may be different. In reality, the factors will be different, right? So your critical analysis of the assumption is necessary. So because the assumptions only leads you to the cash flow, and then from the cash flow only you are projecting how a loan is going to be paid. So based on the cash flows contribution only, you are deciding how much can be lent. So this is very important. So while doing that also, you can't say, you are telling a lie, no, all these cash flow what you are giving, I can't trust these cash flow. According to my calculation is this. I mean, you don't say confrontative. If you do, you are not a good lending officer. You have to very carefully handle that, very diplomatically handle those things, right? So collaborative approach. You don't have conflicts. So those days when I joined the bank, the guys who come to lecture me, they used to say, if you are telling a customer go to hell, you must tell that in such a way that the customer actually looks forward to going to hell, right? He pleasantly looks forward to going to hell. To that sweetness you must tell him, right? That's the way. You have to tell that, but how you put it will make it non-confrontational, right? It will become a collaborative type of a thing. So that is an art, right? Dealing with the customer is an art. So very carefully handle the customer and then put our points across. That's very important, without being confronting with the customer. So that's where a good credit officer will stand out from the rest. So while you are doing the credit appraisal, you always look at the risk level. Now, if you find that risk level is high of a proposal, you always will see how to compensate this. Okay, here the risk level is high. So can I increase the borrower's contribution? Can I ask him to contribute more? Whether his equity can be increased here, right? And the other thing is that we give a higher interest rate. You will know that your credit card and all, even now you will be charging 18%. Why you are charging 18% to a credit card? While you are doing your home loans and all the time, government is telling to lend at 7%. Why credit card we are charging 18%? Because it is a risk, right? We charge a very high interest rate because it is a risk. The risk is high. So you keep a higher return because that particular higher interest rate you charge and collect will help you out to write out some of the risky unpaid credit cards also. Like that, your casual excesses in your branch, you will know overdrafts when people are going above the limit, or when people are being given overdrafts without limits, will charge a high interest rate because it has a possibility of that guy not paying that. If he doesn't pay, your earnings of collecting that is less, you will have to run behind him. You don't have any security, right? So for that, the casual excesses you charge more, right? So based on the risk level. So normally the return is based on the risk. Down the line we will look at the RAROC model also, risk adjusted return on capital also. That's also in Basel 3 also. Basel Accord also it is mentioned. I mean, you must have a risk based. So that is a structured thing. Kind of every customer based on the risk, you go and assign a risk grading to the customer. So that currently also you will do in your banks. You say A1 top customer, A2 slightly lower, A3 slightly lower, A4 even lower, and A5, which are kind of going into kind of a lower credit rating, A6, A7. I mean, every organization will have that kind of a structure. In that, I mean, what is the risk level? Based on the risk level, you price it. You price, if the risk is so much, your return should not be less than this. As a risk-based pricing, right? We'll come to pricing also. That is risk-based pricing. So, so if the proposal's risk levels are high, this is what we had been discussing. Either you increase the customer's contribution, either charge a higher interest rate, you ask for a better collateral, but the security given is not sufficient, better collateral, right? Any other one you will look at. So the lending officer normally needs to know about the market, regulatory environment and all. That's very important, right? So you will look at, while structuring a facility, you will look at what is the amount asked for, what is the timing of the cash flow, how the cash flows are timed, what is the purpose, what is the financial position, right? Risk reward trade-off that will be reflecting there in the proper pricing, right? So how do you risk and reward? How do you do? Are you going to increase the security? Are you going to increase the some other measure? You are going to tell the customer that you need to have some sort of a deposit or build up of the deposit from your monthly turnover, so much of amount you transfer and keep it in a savings account, something like that. Or and then the pricing of the loan you look at. These are all important parts when you are structuring a facility to a customer. So I told you the risk profile of the customer to be you have to in-depth analysis on the customer risk profile has to be done. Then only you look at what is the what is the actual risk, and then when you are looking at the different risk, you will say financial risk. You will look at business risk. You will look at market risk is what you will look at. You will look at your structural risk. You will look at the management risk. You will look at, right, what is the type of, so that down the line we will look at. So all that you will look at, and then you will risk profile you will define, right. Based on all this, you will package your facilities. Either it's a overdraft only, overdraft in loan, overdraft in import loan facility, overdraft in bill negotiation facility, import loan, guarantee facility. All these things you will package it according to the customer's requirement and risk profile. So you will have to justify, right, facilities, why you are giving this much, why you are giving this OD, why you are giving this loan, why you are giving this guarantee facility, why there are sublimits. All that you will justify, right, and the justification of the purpose. And the most importantly, what is the source of repayment? Where this customer is going to pay this from? Whether it is business turnover, whether it is other income what is going to get, all that has to be properly justified. So these are risk I was talking about, major risk factors, with mitigants. You have to analyze when you're looking at that. It depends on the paper. For a small facility, you will not do many. As it goes along, as the facility becomes big, you will keep on analyzing. So financial risk, what is the financial ability of the customer to generate this particular turnover and generate that kind of operating profit, generate that kind of cash flow to repay the loan. As a financial risk, right? So customers' risk in a business model is very important. And the business risk, whether the business is a sustainable business, so whether it is a seasonal business, whether it is a sustainable business, it's very important now. Like, that, there are so many companies in the international market also. It just disappeared, right? So those days we used to take these, when we go for classes and all that, we used to get this cyclostyle, and then we used to get these, those days it was a Xerox machines were there, taking Xerox, and then thereafter photocopiers came. So when the photocopiers came, Xerox machines lost business, right? The cyclostyle machines lost business. And the photocopiers, when it came and it is big, and then now that we are scanning everything and then doing everything is scanned, and then now the photocopier is losing business. Very, usage of photocopier has come down. So those days, the Nokia phone, that Nokia phone all over the world, they were number one. They were number one phone. Everyone, we just called, many people start calling phones as Nokia. But the moment iPhone started coming, smartphones started coming, Nokia could not reinvent themselves, get into this field. They thought that Nokia is world over, they have a big market and nothing will happen to them. People like them and all that kind of thing. So they went into oblivion. Now Nokia nowhere, right? Nokia nowhere. Now they are trying to reinvent and do things and all that, but then it's too late. Like that, they bought the cameras, right? So now who is using cameras? Who is using these film-based cameras? Who is using digital cameras? Very much less. The phones have become cameras. Yeah, right. So like that, time to time, businesses change, and then business risks are there in your own way, in your own. When you are looking at a customer, you must say whether he has a sustainable business. In the market risk, what is the market risk? Whether the market will go down, go up, all that, right? You have to look at the market. The management risk is whether management has the sufficient expertise. Okay, management has a sufficient expertise. Now, like many of the Sri Lankan businesses we have seen, the father painstakingly establishes the business. So father will, many of the, now there is a story telling that St. Anthony's group, the father was, collecting discarded steel items from home to home, collecting and going and selling it to a wholesaler. That's how he started, right? That is the senior Mr. Jnanam. So now he has built up an empire, right? He has built up an empire. All these Tokyo Cement, Jnanam group of companies, St. Anthony's group, Orient City, IT Park, everything is there. So they have built up. The second generation is looking after the business, second generation, and the third generation also is about to come to the business. Like that, you can look at the Navaloka business. Like that, you can look at how all our businesses, whether it is John Keel's or whether it is Haley's or whether it is any business, you can look at how it has come. So many companies who are like started very small with one person's entrepreneurship has become big companies in their second generation. Right. And sadly enough, some places where the second generation is not very concerned. So sometimes they fight with each other, divide, and siblings they fight with each other and divide, and business is divided. One classic example I can tell, in India, Ambani group, Dhirubhai Ambani, so he single-handedly put up a huge conglomerate. Now that one of the Ambanis, what it is, Mukesh Ambani is kind of one of the world's richest people. I think he may be in the first 10 world's richest people. Probably they have about $30-40 billion worth of assets. And when the father put up, and then when the father died, the sons fought with each other, and then they divided. And the other guy, Anil Ambani, one son, the younger son, he messed up with his business, and then he is almost out of business type of, right? Anil Ambani. So this happens in Sri Lanka also. In many businesses we see people in the second generation, third generation, they sort of, they don't keep the values of the seniors. They then mess up with the business, and then business goes into trouble. So the management risk, when you are looking at, you will have to look at who is managing the business, whether it is professionally run, who is looking after marketing, who is looking after the finances, who is looking after the the overall management, how sustainable is that? That's very important. Whether the succession is properly planned, whether it is a single dependency is there, whether it is depending on one particular person. If somebody leaves, whether the organization will be in trouble. Those are all management risk. Then the structural risk. That also, like for the purpose, I told you, structural risk is very important also. How do you structure? Somebody wants to put up a warehouse and they are asking for a small working capital facility also. You're giving an overdraft facility for a warehouse may not be the right thing, because warehouse is a capital investment. They are going to go and do a capital investment, that is once and for all they invest, and then over a period of time they will pay, and then they will capitalize that. So for that, you giving a working capital facility of revolving loan, or with giving an overdraft facility, what will happen is that customer will not pay the capital. That's wrong structuring, right? So a combination of loans, overdrafts, combination of revolving loans, a combination of loan for a particular capital investment. All that has to be properly structured. The structural risk will decide whether this particular customer will pay or not in the long run, right? So structure is very important. So the good lending officer will be very concerned about how he structures the facility, not according to the customer what he wants. It is according to the assessment of the lending officer. He will assess what has to be given. If you just go and give everything what the customer wants, you may fall into trouble because structure may be wrong. You may be giving a higher or lower amount in wrong structure, and this can fall into non-performing. So that's about the structure, right? And then the security risk. You look at the security risk. The security risk is the your ability to turn your security into cash to settle your loan in a worst case scenario. That's a fallback scenario, right? So that's why the quality of a mortgage property. People make a lot of mistakes. They go and take a property which has no proper right of way. If you don't have a proper road to a property, even though you have valued and all that, that has no value. You need to have proper roadway. And what kind of things are around? If it's a residential property around, if you have factories, it will not have a value as a residence. Residential property, we taking a mortgage is not going to be of value. So in a very good neighborhood, in a good residential neighborhood, the market will be there, but not in an industrial area as a residential property. So all these need to be looked at. Security when you are taking now that we will subsequently we will look at every security also, because every security has a different quality, like whether it is a residential property, whether it's a commercial property, whether it is a stock, so whether it is a book debts, whether you are taking as a mortgage, personal guarantees. We need to speak more on this, right? So any question up to this? Any question up to this? Yes. I went a bit slow today because this is the bread and butter of banks profitability and the purpose of this particular course. So the basics, fundamentals, you must have a better knowledge. So I went a bit slow, and we'll continue with this next week. Two, any question? Are you all okay with this? Are you all okay? Any comment?
Yes, sir.
Okay. Any comments? Any suggestions? Any anything you didn't understand? Right? Okay. So thank you so much for a patient listening. Please try and communicate. Be interactive. Sometimes I feel lost if you don't interact with me. So do interact with me. I hope you would have started with your assignment also. So please see that before January 15th you put it, so that we can complete those assignment functions, and then an exam also we can do and complete in time, so that you all will get the results faster. We'll try to do that. So thank you so much for patient listening to me. Have a good evening, and enjoy with your family. If you have kids and all that, enjoy with your family or your spouse or that, and then have a nice weekend. We'll meet up next week. Okay, bye.